months gone over this trajectory where it was creating substantial uncertainty in the bond market in order to deal with inflation that arguably was created by some of the fiscal policy choices made along the way by the U.S. government and by both parties. Understanding that trajectory means that whether or not the Fed goes through with that second hike in September, that they're signaling that the job is almost done, or that they've almost got inflation under control as they feel they do. So you've switched from massive uncertainty in the bond markets, creating volatility in the way that I think municipal bond investors understand that if you've got elevated volatility and you've got negative total returns because yields are going higher, that regardless of the fundamentals, that's a really negative backdrop. We're kind of reversing that and putting it on its head right now.
I'm fascinated by when I look at fixed income in the equity market. We all have a legacy of shadows and opaqueness out there right now. All my radar is up on this opaque word loans, or leveraged loans, or that. Does Morgan Stanley Fixed Income Research feel there are challenges in the fixed income space, shadows that we really can't observe?
Well, yeah, absolutely. I mean, so for example, once we get into 2024 and then really escalates through 2028 in leveraged finance, there is a substantial wall of maturities. And unless you get a meaningful amount of free cash flow growth, you're going to get net interest coverage going down substantially. So, for example, if you assume, which I think is a far too conservative assumption, that you don't get any free cash flow growth, about a third of single Bs all of a sudden have sub one times coverage. So that's a real challenge, and arguably it's one of the structural challenges that's kept spreads relatively attractive. Another one that's kept spreads relatively attractive is the bank demand issue and how that's changed since the regional banking crisis. So these are things we have to watch on the horizon. They're secular headwinds, but I think the setup for high-grade bonds right now is pretty positive, at least into year-end, because you're taking away this uncertainty from the Fed and fighting inflation.
Something we've been digging into over the last week or so is who is actually paying these market rates. And a question I've asked, and if you could give us an idea, don't expect the precise numbers, but just the difference between what a company's coupon is right now from debt issued in the last couple of years to what the market rate for that interest is if they came to the market today. Just how wide is that?
Well, okay, so our chief cross-asset strategist, Andrew Sheets, wrote about this on Sunday, and it's fascinating that in a lot of ways across the capital structure of markets, the bond is yielding more than the asset that's financing, which is totally upside down. So the investment grade corporate credit index yields about 5.4%. The Russell 1000, the earnings yield is only about 4.8%. That's not totally unprecedented, but it's pretty unprecedented. It's only happened 2% of the time in the last 20 years, right? That difference kind of makes sense if you thought that we were about to accelerate economic growth pretty substantially, but we've got the opposite view. Our economists think we're continuing to slow down. Obviously, we haven't slowed down as much as we thought we would, but without that growth, then there's a problem if you're having to finance with a higher yield than you're actually earning from.
Tom touched on this. When does this start to bite? Can we just build that out just a little bit more? It's going to bite certain parts of the economy and certain issuers more than others, quickly than others. But just on average, when does it start to bite?
Well, I think it's already starting to bite, and I think the last CPI print sort of showed that, right? And it's part of the reason that our economists, I think if they were here, they would tell you that the Fed, yes, they're going to hike this month, but I think ultimately are probably not going to hike in September because the accumulated effect of everything that's being done so far is going to be tightening in and of itself over the course of the rest of the year. So that is also a good setup for bonds and bond yields and total returns.
What does the Bloomberg Total Return Index do off Lehman and Barclays? I'm looking at a Microsoft. I picked Microsoft, folks, just because the earnings up. Believe it or not, Microsoft does have debt. I don't know if you were aware of that. I go out 10 years, the Microsoft 2 5/8 of 33, and I've enjoyed a Tom Keene price decline from 130 down to 97. What's the likelihood, given high rates and sustained high rates, that we see a price breakdown through the lows of the last number of months?
I don't know that you necessarily get a substantial price breakdown. I think a lot of the return you're going to see is going to come off of yield and coupon, mostly because while the Fed could be closer to the end being done hiking, there's still the secular headwinds that we talked about, right? There's still the bank demand headwind. There's still some lingering credit issues. So it's not necessarily an environment where you're going to get yields moving a lot lower or spreads moving a lot tighter, but clipping that coupon in and of itself is quite attractive relative to equities, which are probably going to be more challenged in our estimate.
It's like channeling Mike Wilson there. I mean, you see how
Is that what you think?
It's channeling Mike. You know, how much do you and the equity guys talk to each other? I'm
A lot.
fascinated by that. I mean, Mike's making all the headlines today, talking about the challenges of a bear market call. He hasn't changed his view as well. But how much does fixed income at Morgan Stanley go back and forth with equity?
Oh, the collaboration is constant. Yeah, I mean, we're on the same floor, we're by each other, we're on calls weekly, collaborating, making sure that we're challenging each other. So the answer in short is a lot.
Michael, this was great.
Yeah.
It's good to see you. Thank you, buddy.
Thanks so much for having me. Appreciate it. Thank you.
Yeah.
Just awesome, as always. I want to turn back to GM. So this is what's happened in the last 41 minutes or so.
I am not.
So General Motors, what was that?
I'm not up to speed on this. Go ahead.
Okay,
Yeah.
I'm trying to do that now.
Okay.
So 41 minutes ago, General Motors came out and released some partial results in Chinese on their own website. And then Tom released the actual results 30 minutes after that. But all you need to know so far is they raised their outlook for the year. And the stock, Tom, slightly positive in the pre-market.
I wonder what it's going to do to embargoes. I mean, the first thing I thought about, John, is this whole embargoed fiction in an age of digital speed. You know, I'm sure they're sitting there in Detroit, and frankly, every company is looking at this and going, what's the value of making that mistake with some form of embargo
It's not clear to me
process?
that anyone broke an embargo here, Tom. This
No,
was
you
them
said-
publishing it on their own website in a different language.
Clumsy. I mean,
Which
it's
is
really brutal.
Slightly bizarre.
Yeah. But there it is, and, you know, it's good numbers. I've got the presser in front of me. I guess I go with it from Fort Worth, Texas, second quarter. You know, it's GM Financial reporting some good numbers. I don't understand, John, how you make money here over long term. I get the idea you can get a cyclical pop in the auto companies as well, but I'm looking at GM back. You can do this on the Bloomberg, folks, on the TRA screen. Wow, it's made 3.5% per year last 10 years. Minting money. I just, you know, I don't get it. I mean, I don't get Tesla either, so.
Well, Tesla got hammered last week off the back of disappointing earnings. Netflix did as well. So let's see if we get the same fate for the likes of Microsoft and Alphabet a little bit later after the closing bell this afternoon. That's where the attention's going to shift to. Some of the heavyweights of big tech reporting after the close today. It's on to Meta on Wednesday. Tom, I was led to believe that Amazon came out this Thursday. It actually comes out next Thursday.
Yeah.
Alongside Apple.
Yeah, I got that wrong. That was my fault. We got the date calendar wrong. And, you know, it happens there. And one of the great things to do, folks, on the Bloomberg, the DES screen really will give you the guesstimate. I think, John, is the best way to put it. The estimate of when earnings will come out. Some of the companies are really repetitive in that, and others a bit of a surprise. But Amazon, I believe, comes out with Apple on the same day. It's a trifecta. Like
Next Thursday, after the Bank of England,
Yeah.
we get a trilogy of central bank decisions this week as well. The Federal Reserve two-day meeting begins today. The decision is tomorrow. It's on to the ECB on Thursday and the BOJ on Friday. We'll talk about some of that with Heidi Kribo-Rediker of the Council on Foreign Relations. That conversation just around the corner. Equity futures right now on the S&P 500 positive by almost 0.1% from New York. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
To the kabaddi tournaments in India.
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
From New York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Regarding the ECB, yes, I think it's very likely and it would be reasonable to pause. I think currently it's unclear whether the inflationary pressure has been overcome entirely. We know that core inflation is quite stubborn. So I think how this goes on is an open question. But in the current situation with the weakening economy in Europe, I think it would be wise to halt.
That was the IFO president on German business confidence, which is not great, going into an ECB rate hike decision on Thursday, which most people anticipate will deliver one. Another 25 basis point hike potentially from the ECB president, Christine Lagarde, and the governing council, even as the PMIs look pretty terrible. But inflation is still a problem. And I think this is the lesson for maybe the rest of the world right now, is that you can have a weaker economy, Europe, and still have an inflation problem. Europe. That is the nightmare scenario, I think, Tom Keene, for Chairman Powell and co. a little bit later this year. Right now, as far as things stand, he doesn't have that problem. The hopes and dreams of a soft landing are still alive, encouraged by the data we've had in the last couple of weeks.
I don't know how to weight this. The movable pieces of a Fed, and of course the theme of this summer is American exceptionalism. The Bank of Japan, a complete theoretical mystery. And as you mentioned, the complexities of Europe. But what I would emphasize, John, is too much of the fancy analysis doesn't mention the small issue of a war in Ukraine. There is a legitimate war going on in the continent of Europe right now. That's not mentioned enough within the economic, the finance, the investment talk.
Well, the crisis of Europe that wasn't the energy crisis, Tom, that they managed to avoid through the winter, that was the good news for the European economy. That was the good news. What we're starting to see this summer, though, is some real economic weakness start to emerge. Now, some of that's by design because of the rate hiking cycle of the ECB. And you see some of that in the demand for loans that came out this morning. But have we got to a point now where the ECB needs to back away? It's going to be a really interesting decision on Thursday. I think the Thursday decision is far more interesting than the Federal Reserve decision tomorrow.
With all the heritage of the Bundesbank and such, it's going to be great. We need someone to synthesize this right now on a global basis. Heidi Krebel-Redeker is Senior Fellow at the Council on Foreign Relations and is really quite good at tying in all these different threads in a hugely confusing post-pandemic time. I want to go to one of your headlines, Heidi, which gets out front and says this could be a successful Fed. It could be a successful Jerome Powell. And you state we need to begin to frame the idea of Powell as hero. Discuss how the chairman of the Federal Reserve System could be a 2024 hero.
Well, I think you have to give him a lot of credit for coming through COVID. I think we all have we've blocked out part of COVID, but the fact that he managed through COVID, that he is defying many expectations, particularly of the macroeconomic priesthood that he is not part of, who very much doubted that he would be able to navigate the waters coming out of COVID. And so we do have the higher probability of a soft landing. And if he is able to stick that, I think that he will be, it will be a heroic feat. He is aiming for that balance in both labor and taming inflation. But we have seen a lot of progress. We are seeing that balance fall back into much more manageable space, and all of the debate over the past several weeks over whether he should change that 2% target, I think, missed the fact that there's a great deal of credibility tied to that 2% target, and that I don't think he will change that over time.
Within your writings for Foreign Affairs, you're a great student, as John mentions, of Europe. And I'm really interested in how you feel the inflationistas, the Bundesbank, maybe Netherlands is in there, Austria, how the core of Europe and their ancient concern for inflation, what power, what sway they hold at the ECB right now?
Huge sway. And I think that the focus on the ECB's decision this week is key. Christine Lagarde I don't think there's a lot of debate about what we're likely to see both out of the Fed and out of the ECB this week. But there is a history of fear of inflation and much more concern about growth in Europe right now. And we do have to remember that, as you mentioned, there's a war. War is inflationary. We're seeing grain ports bombed by Russia. There is a chance that we could see weaponization of energy again and prices spiking in Europe this winter. Europe is not ready for an all-out spike in energy again, and you can't just pray for good weather as a strategy. So I am slightly concerned that this winter might be a tougher one.
Heidi, how much of this slowdown we've seen so far this summer before we get to winter, how much of this slowdown is by design, that the ECB actually wants to see this take place?
So again, it's a matter of balance. It's a matter of balancing growth, bringing down inflation, and then I think we also have to look at what's happening in China, given the weight of the Chinese economy in the global economy, because you do have a slowdown that could have shocks on the global economy that we might not be paying as much attention to.
So the Politburo came out yesterday with a range of measures, a lot of rhetoric in there about supporting consumption domestically, doing things for EVs and all of that. Heidi, I was reading through some of those headlines and I was just wondering, how much of this should I take seriously? How big is this effort? What was your take on things?
So I think that the political messaging is stark. You had the party and the state council come out last week with measures with very deliberate messaging that the private sector will be supported equally to SOEs. You have a lot of messaging and meeting with investors, with large institutional investors. They want investment. The rhetoric has to be met with deeds and what it will take to get those to get that investment back. It really has a lot to do with the transparency, the lack of transparency heading in the wrong direction,
right,
with the fact that you could actually see a reaction that we saw over the past 2 years towards the growth of tech, towards any. Sorry,
I don't mean to interrupt, but I think what you just touched on is the absolute key issue. This is what Heidi Krebel-Rediker is famous for, folks, cutting through the BS. Is China so desperate for our foreign investment into China that it could change the policy certitude of Beijing and the dictatorship?
So you have the messaging. Again, you need the deeds to meet the message. And there has been a significant initiative to message to foreign investors that China wants them back. Whether that will happen, you have a myriad of risks for those investors to come back into the market. And the reality is, as Janet Yellen pointed out, the U.S. is prioritizing in that area of national security over commerce. But the Chinese do that on steroids, and they have done for quite some time. So you do have to balance those risks if you're going back in full throttle to the Chinese market. And I think it really has to do a lot more than words to get people back to where we were pre-COVID.
Heidi, thank you, as always, for joining us. Heidi Krebel-Rediker there of the Council on Foreign Relations on some of these central bank decisions still to come this week, and some of the challenges domestically, the effort to balance opposing forces in places like China.
People go, why are these people on? This is textbook Heidi Krebel-Rediker, where she talks about the greater theme of China and all the things spinning in her head and distills it, John, right down to what do the Chinese need from us? They need investment. How can we give them investment given the politics and given the micro decisions made out of Beijing. Frankly, also the micro decisions made out of Washington.
I think we're still waiting for
that's
that
just
outbound investment restriction package to come from Washington, right?
Well, we're going to get the actual package, but I think there's the action of corporations as well. They're sitting there going, you know, what's the easy answer right now if you're a corporation? Well, it's delay. I mean, unless you're X. X can be out front with an investment right now.
I would love the backstory on what happened over the weekend with that Twitter effort. I've got no idea.
We should have Linda on.
No
Linda,
idea.
come on, man. You watch every morning.
I don't
Linda,
think
come
she
on.
wants to do media right now, but I mean, we can try. Dan Greenhouse of Solace Alternative Asset Management joining us shortly. Big day, big afternoon for earnings. Coming up a little bit later from New York. This is Bloomberg.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Forget a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
Earnings season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
The moment news breaks, no one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI, semi sort of trade here.
The $69 billion deal was the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority.
The real growth picture is pretty poor everywhere.
From an economic perspective, I think all of us expect a deceleration, a slower economy.
This is the environment where you have to be more nimble.
We're cautious and think that the conditions are there for a full-blown recession.
I think we're going to get a lot of clarity this week.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The week begins today. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Your equity market positive by 0.1% on the S&P 500. Bramo's still out. She's going to be back with us tomorrow for that Federal Reserve decision.
So she says.
Then on to the ECB on Thursday, the BOJ on Friday, and tech earnings kicking off in a big way later on this afternoon. Microsoft and Alphabet just around a corner after gains of in and around 40% year to date on those two names.
Yeah, this is going to be interesting to see. We're going to dive into earnings season. The guest we've got coming up here in moments is enthusiastic about earnings and the upside and all that. I want to also note here, John, that one of the great things here is that corporations adapt, and we see that moments ago, Biogen out. Forget about the numbers, and there's a headline, plans to cut 1,000 jobs. What's critical there, John, is they only have 9,000 employees. So that's like a real cut. Just the headlines don't matter. It's a percentage change on right sizing. How will the banks right size? Will tech continue to right size? These are some of the questions on the conference call.
How much more multiple growth can we get from just talking about AI repeatedly, Tom?
I think it's a valid, you know where I am on this. I don't believe in it. I was polite with Anurag Rana, but I think you're dead on. AI, AIE,
We're going to count how many times that phrase comes up on earnings calls a little bit later on this afternoon.
I'm going to cut him some slack. I don't think it's nanotechnology, which I thought was complete BS from the get-go. The nano. Remember the nano 10 to
yeah, that was good.
But the idea is there's some substance here, but what I hear from the adults like Anurag Rana and Mandeep Singh is you go out. Mark Mahaney's on later today. You got to go out in time.
Looking forward to catching up with Mark. We'll do that about 9:40 Eastern time on some of the tech earnings later. Got a great guest with us right now, so let's get straight to it in the equity market. Equity futures right now on the S&P 500 positive by 0.1%. There is a lift here in the bond market. Yields a little bit higher by a couple of basis points. Your 10-year 389.24. And here's this move in the euro. It's not a big one on a daily basis intraday, but it's relentless over the previous 6 days. 6 days of euro weakness. We had this string of euro strength, now replaced by euro weakness, 110.45, negative 0.2%. Fact of the matter is, the data in Europe at the moment, Tom, does not look great, and the ECB is about to hike into it on Thursday.
No, they're going to hike into it, and it is the biggest risk. I think we've identified that right now. But I'm going to go, there's no Jackson Hole there. They had Sintra already, but what's the debate on ECB into the Q3, into Q4 as well? And I think, there's a huge mystery about Q3, Q4 in economics. Some of that will be clarified at Jackson Hole.
President Lagarde, Thursday, before we get to Jackson Hole
We
next
have her
month.
on the show?
We don't.
Oh.
She has a news conference, though, which you're welcome to
Sorry.
attend in Frankfurt, Germany, if you'd like me to fly you out.
Yeah, that's good.
Dan Greenhouse, Chief Strategist at Solus Alternative Asset Management, joins us around the table. Dan, good to see you.
Good to be here again, guys.
TK gave us the spoiler there. You're optimistic on earnings season, pretty constructive. Tell us why.
Well, listen, first of all, let's look at who's already reported. The airlines have told us demand is quite strong. The home builders that have reported thus far have said demand is quite strong. The banks were terrific. I think an underreported story, and I'm a nerd about conference calls, but an underreported story was the CEO of PNC Bank. PNC is obviously not JP Morgan or Citigroup, but it's a tremendously large bank with an enormous loan book. And when asked about the current state of the environment, the CEO of PNC cut himself off mid-answer and said, we aren't even having a soft landing right now. The economy's been quite strong. And so from my standpoint, I think that's going to translate into actual operating results. Obviously, that hasn't fully materialized as of yet, but I've been pretty optimistic over the last couple of weeks that this is going to be a better than expected earnings season, more so than it normally is.
For the gloom crew on the income statement, where's the greatest misjudgment? Is it revenue? Is it down the line? Is it this input cost debate that's out there right now? Where's the thing the gloom crew is getting most wrong on the income statement?
The gloom crew is probably a pretty small group at this point. I mean, price action has eradicated much of that group. I think there is concern on the top line. I mean, there's a pretty good relationship between nominal GDP growth and nominal earnings growth in the S&P 500. And as inflation comes down and nominal GDP comes down, that top line growth has slowed and is continuing to slow. So I don't mean to suggest that all is well. What I think I'm operating on is more of a relative argument than an absolute one, that some of the more negative arguments that were put forth for much of 22 have unfortunately fully carried over into 23, and they don't appear to be materializing the way, obviously, some people expected.
You and I sit in the conference calls, and you get a character there. What is the character of tech conference calls this week?
Well, listen, I think to John's point earlier, they're going to try to ride this AI train as long as possible.
They're really going to climb on board.
I mean, listen, we've all been around the block a few times. How many times have you seen the same headline hit the tape and goose asset prices repeatedly? And how many times can you throw up your hands and say, we already know this, and it works every time? And I imagine on the AI side of things, that's probably going to be the case again. Although admittedly, this is a real thing. It's not, presumably orders are materializing. Companies are actually implementing this in a material and perhaps cost-effective manner, and that's going to have real-world benefits for companies in the immediate. And so I think that can be measurable, and ultimately it may not just simply be the same headline over and over again if the data continues to back it up.
You know the new obsession, the catch-up trade, the rally broadening out, time to rotate away from big tech. Where do you stand on that now?
Well, listen, I mean, the rally is and has been certainly broadening out. And to be clear, through the spring, it was undoubtedly the so-called Magnificent Seven. I mean, there's a bit of revisionist history going on that somehow the broad rally has always been the case, that it's not just 7 stocks. For a long period of time, it was just 7 stocks. But you have a tremendous catch-up now on the part of small and mid-caps, as we know, and the rest of the index is playing a bit of catch-up as well. And a lot of that has to do with the economy not being in a recession. I think we talked about this last time I was here, that around the middle of this year was when, excuse me, my group expected something resembling a recession or a worse economic environment would materialize. Now it seems pretty clear that we're here. Not only is that not the case, but we're very unlikely, as it stands now, to have a recession even this year. And if that's the case, you're going to start to see, and now indeed have seen, a rotation away from the big names into the other names, because the supposed economic weakness that I forecast, and by extension the earnings weakness that would materialize as a result, is certainly not here.
How sticky is that money in money market funds? Far more interested in the rotation that could develop there than maybe from tech to cyclicals. What does that look like?
Yeah, I don't have the answer. I mean, listen, you're getting 5%. If you go a little bit out on the risk spectrum, commercial paper type stuff, you can get 6%. And so from a return standpoint, if you build a portfolio or you just adjust your portfolio to have a core of 5 or 6%, let's say, and then around that you build a diversified portfolio of high yield bonds, corporate bonds, and equities, you can have a pretty attractive return stream with a lower beta that for most people, institutional and otherwise, is probably not an unattractive return stream. I mean, for us, we do a lot of higher risk, high yield bond, distress type investing. And that return stream is going to be considerably more volatile no matter what. But on balance, I think when you can have a core of your portfolio returning 5.5%, 6% on 90-day paper, that's really hard to argue with.
Does diversification work here, or is it a time for more concentrated bets?
Well, listen, in general, I subscribe to the Warren Buffett, I believe it's Warren Buffett line of thinking, that why should I put my money into my 6th best idea when I can put more money into my 5th best idea? And I think there's
that's the John Farrow theory.
John Farrow, Warren Buffett. There's
what's the difference, Dan?
It's very hard to tell them apart. But on balance, I subscribe to that. But we're institutional investors managing hedge fund money that's presumably long-lasting and sticky.
8 months.
Depends, but for a lot of retail investors, I think it's very hard for them. They've been taught, and financial advisors have been taught for years, that diversification is a benefit both within sectors and geographically, and I don't think that's going to be a thought that's going to break anytime soon. And to a large degree for that investing class, I don't think it is an idea that should be broken anytime soon.
Let's talk about high yield just to wrap it up.
Sure.
Up in quality is the buzzword, the phrase that I sort of get thrown at me every time I talk about credit. People just say, yeah, we're up in quality, whatever that means. Can you tell me what you're doing in high yield specifically, what the opportunity set looks like, given how tight we see spreads on a daily basis at the moment, I think near the tights of the year currently?
Sure. Well, listen, coming into the year, that was the argument. You want to be up in the capital structure. You want to be safer, because for the same reason that the equity market was supposed to continue moving lower, those safer parts of the capital structure were supposed to outperform. That hasn't been the case. Loans, which are higher up in the capital structure and have a first claim on a number of assets, they've done better this year than have high yield bonds. And so much like what's happened in the equity market, that part of it's been a bit of a surprise in the corporate bond market. For us, we're not like a closet indexer, or we're not trying to do those capital arbitrage trades. We're an absolute return vehicle, and for us, lower in the capital structure has been rewarding. We've done a lot on the energy space. although admittedly there's very few distressed or troubled energy companies anymore. But further down the capital structure, what we found was there are a lot of companies in the consumer and leisure side of things that look mispriced to us, and where our performance has been generated this year and continues to be generated is in a lot of those names. If you look at things like hotels and movies and cruise lines and anything public events, anything that involves the consumer doing things, we thought was mispriced and in a large degree continues to be.
We've seen that in equity in a massive way for the cruise lines. I mean, that's just been its own story. The default cycle, are you seeing signs anywhere that it's starting to pick up?
Oh, sure. Listen, you're back to about average default rates, which isn't saying very much, but on the back of very large structures, relatively speaking, like Envision Healthcare, the default rate has started to tick up into, let's call it the 3% range. And I think my expectation is that that's going to continue if you include what we call distressed exchanges. My expectation is that default rate is going to continue to tick up. But I think this is an important story that Chris Pacillo, our CEO, has told investors for as long as I've been at the fund. You don't need an economic cycle to have a default or distress cycle. And we've seen this repeatedly throughout history. And I think that's what you're seeing now, a pickup in default, a pickup in distress activity that's independent of an economic cycle that appears to be holding in there quite well. But the interesting story is going to be 6 months, 9 months, 12 months down the road if the economy does indeed fall under the weight of what the Federal Reserve has done, and there's no guarantee that's the case, then what we've seen thus far is just going to be the tip of the iceberg.
It's been absolutely fascinating the last 12 months. Dan Greenhouse, it's good to see you, Dan. Come back soon.
Thanks, guys.
Dan Greenhouse there of Solace Alternative Asset Management, TK, on this market. A more constructive view there on earnings, and particularly a little bit more constructive on some opportunities in high yield that I think we haven't heard much of over the last few months.
Well, the linkage there to Solace to the high yield, and as Lisa has mentioned as well, the spread market speaks volumes, and that people are voting for high yield, maybe as they're voting for, retail's voting for equities to sustain. I would go back to my arch theme, which is companies adapt, and that's what we're seeing right now, whether it's General Motors or Microsoft this afternoon. I don't, here's a headline. I just noticed the paint company, John Sherwin-Williams, is a all-American name of paint. John, you get a new place, John, you move into a new place with 4 bedrooms and the view. No, I'm thinking of other people.
Okay.
You got to go out and get 15 gallons of Sherwin-Williams paint. The answer's up 6.3%.
Beat and race from them from New York. Welcome to the program. If you're just tuning in, the S&P 500 currently positive by 0.1%. Coming up in about 30 minutes from now, we'll catch up with the General Motors CFO after they raised their guidance about an hour ago. TK, GM this morning, General Motors, the CFO, a little bit later this hour.
It's going to be interesting to see what he says. I mean, that's all there is to it. He's an Auburn guy. He's a Southern guy. Gets manufacturing down the corridor from the Midwest down to the South, and it'll be interesting to see what he says. There's some distractions here with the earnings announcement this morning and this embargo stuff and all that. But the real distraction for me is EV. What do they do, and frankly, what do others do with EV?
And whether this is it, whether this is really
no, you've been the one.
Deal.
Yeah, but you have nailed the thing. I can't get an answer to. Dan Greenhouse probably knows the answer. Are EVs thermodynamically on an energy basis? Are they a plus versus internal combustion? I don't have an answer.
And what happens in 10 years if everyone was wrong?
I don't.
And they're sitting on these massively expensive investment cycles.
Why is it so hard to find the answer to this? That's what I don't understand.
Well, they're committed to it, that's for sure. And they're not alone, and they've been rewarded to it in the equity market in many cases. Equity futures on the S&P 500 positive by 0.1%. Marilyn Watson of BlackRock later this hour from New York. Good morning.
that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority. The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Wednesday, the market expects another rate hike.
They're getting the message loud and clear. The Fed wants to go again.
The then what is the big mystery.
But will it be the last of the cycle?
Is it one and done or more to come? Does the Fed make policy based on what they're worried about or what they actually see?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Twice more is not too high of a bar.
The Fed wants all options on the table.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
Part of the argument against high yield this year has been the spread's not interesting at all. And but you can create, I mean, there are a bunch of parts of the fixed income market that actually you are getting paid for. There are parts of great. By the way, European high yield, if you're a dollar investor, you swap it back to dollars and you get paid well into the nines for getting that. That strikes me as fair.
That was Rick Reeder, Global Fixed Income CIO over at BlackRock, talking about the opportunity set in fixed income. It is summer, Tom. He's allowed to be tanned and rested.
Unlike you and me.
I'm tanned and not rested. I don't know about you, TK.
No, I'm not.
Busy summer gets busier this week, that's for sure. Tons of earnings, lots of central bank decisions going into it. Equity futures at the moment on the S&P. Slightly positive on the S&P 500. Just a small lift, Tom, to kick off this morning, this Tuesday.
Yeah, very importantly, John, here, you know, we haven't mentioned it today as well, but the Bloomberg Financial Conditions Index shows the accommodation Chairman Powell does not want. It's pulled back a little bit in the last 24 hours, but decidedly more accommodative than anybody within central banking would like to see. And that augurs for 25, maybe even another Andrew Hollenhorst kind of 25 on top of that.
To state the obvious, given the recent data, I'd say he's less concerned about that now than he was 12 months ago.
Yeah.
Very different backdrop for this Fed chair.
Yeah, maybe Dan Greenhouse is advising Jerome Powell. And
you reckon?
Calm down, earnings are going to be fine.
Hey, some optimism there, hey?
Yeah.
It's welcome.
You know, it is. And the optimism today you see in the market with S&P futures up 6. Right now, this is important. Who I would go to is Elizabeth Economy, but Dr. Economy is working for the Secretary of Commerce and is not available for media. She has been definitive on the fragilities of Beijing, Xi, and Chinese leadership. Amory Horton is our Bloomberg Washington correspondent, and with an announcement made in the last 10 minutes that the former head of foreign policy for Xi will take over again, and the former ambassador to the United States is out the door. This has been widely speculated, a number of good write-ups on this, even in the last 24 hours. Amory, I'm going to suggest this is not a surprise, but I would suggest there's a massive mystery to this. What does Washington believe happened?
Well, it is not surprised that we have this movement today that was pretty much given a nod from the Chinese government yesterday. This was coming down the pipeline. But what we still don't know is what happened to Qin Gang. This is the former U.S. ambassador. He was elevated at a very young age, one of the youngest we've seen in 70 years, to be a foreign minister in China, handpicked. And he's been missing for a month. We have not seen him since he took some diplomatic engagements on June 25th. And there's been a lot of speculation within the Chinese press as well that has not been censored by the Chinese government. One of those that he had an extramarital affair. We do know how China feels when you start to poke around and try to find out what's going on with officials, maybe a health concern, but we just do not know. When Jake Sullivan was asked about it, he said, "We don't know." Quote, literally, we don't know. So there's going to remain a lot of speculation about this, but China clearly was under pressure to make sure they had an individual to represent them because some foreign diplomats were also starting to cancel some trips.
I mean, Anne-Marie, that's a beautiful summary that we only get, folks, from Anne-Marie Horder. And I would suggest my focus, Anne-Marie, is on the ambassador of the United States to China. Nicholas Burns has been a huge supporter of what Bloomberg surveillance has done over the years. There's been some recent activity there about emails leaking out and this, that, and the other thing. With this Chinese upset, how does it affect Ambassador Burns' relationship with Beijing?
Well, this is an individual that the American foreign policy apparatus, whether it's you're an ambassador, whether you're Tony Blinken, you know who Wang Yi is, right? This is an individual that everyone is well versed in. So I'm not sure it changes that much, besides a lot of palace intrigue and concerns over what else is going on behind the Iron Curtain when it comes to Xi Jinping and other members of his government. This is something they keep very close. So I think there'll be a lot of interest into what happened to him until we exactly find out. When you look at Nick Burns, though, of course, this has been just another salvo, really, between Washington and Beijing, and really just heats up the tension. Not just his emails were hacked, but a number of others as well. And obviously, that's quite concerning if you're an ambassador in that country. But I don't think anyone was actually surprised that the Chinese government was trying to hack into their counterparts' emails.
If you wanted to find out what was going on right now, would you call Blinken or Kissinger?
At this moment, I think I would call Henry Kissinger. For the fact is that Henry Kissinger got a meeting that no one in America has been able to get, and that is a sit-down with Defense Minister Li Shangfu. He has still yet to meet with his actual counterpart, Lloyd Austin, and that is because of sanctions that are on him. The Chinese government maintained that until those sanctions are lifted, he will not be able to meet. We should note that having sanctions on this individual does not mean he cannot have a sit-down with his counterpart. But Henry Kissinger is the man that had all the access recently in China. He likely will be briefing the Biden administration, and he's the one I would want to have a conversation with.
Okay, but you're going to be on a plane, Anne-Marie, to Beijing. I believe Biden is going to meet with the Chinese leadership here. I'm going to use November as the operative guess. Does that change here? How is that nuanced in the coming days?
I am definitely not going to be going on a plane to Beijing. If Biden is set to meet with Xi Jinping in November, that will be happening in the United States.
Oh, in the United States,
if they were to meet, we'll be going, all of us, to San Francisco. We'll be waking up very, very early to make sure we hit the 6 a.m. Eastern time of surveillance. But that'll be happening at the APEC summit. Potentially, the two others. The two can also meet at the G20 in India in September. This could be a potential first meeting, but I think if you're going to look for something more substantive, they might want some more time in November. But this is obviously a guessing game. We do expect the two to meet. We expect them to also have a phone call. When is that phone call that Biden says he has been planning to have with Xi Jinping happening? I don't think Qinggang changes any of that potential pathway. But I think there's a lot of curiosity now, or the curiosity has grown now within the United States, within Washington, D.C., about what happened to this individual, especially as he was really a rising star in the Chinese government apparatus.
Well, for the president at the moment, we're going into election year. Anne-Marie, the status quo, the relationship between China and the United States as it stands, is that beneficial to the president?
I think the status quo at the moment is that they are trying to set a floor, which they have been trying to do since November when Biden sat down with Xi Jinping at the G20 in Bali. And I was there for that meeting. And the whole point of the meeting was to set guardrails and to now conduct Washington to Beijing, counterpart to counterpart conversations. So what we have seen the last month and a half or so is a number of those meetings take place. Yellen, John Kerry, Blinken went over. But obviously, what has really changed? Not much beside a dialogue that they wanted to do almost a year ago. And we're going to still see this administration come out with more measures against China when they look at national security. This was according to the Treasury Secretary. And we could see as early as the end of this month, likely the end of next month, that executive order on outbound investment, will be coming out the door.
You know, what's great about this, John, is when Biden meets with Xi in San Francisco, what Anne-Marie does is she's not at Charmaine's. That would be, you know, it's too hoity-toity posh for Anne-Marie. She is a top-of-the-mark girl. She goes to the top of the mark, which is the iconic World War II bar in San Francisco, and she just goes directly to a 312, you know, hit with us.
We're talking about
interview
bars.
with us. Yeah, top of the mark in San Francisco. Anne-Marie's going to do the top of the mark and then go straight to her time with us in the 6 a.m. New York hour.
Working at East Coast hours on the West Coast is brutal.
It's brutal.
I don't know.
You know.
If you're listening, the team over at PIMCO, I feel for you.
Oh, yeah. And you never get used to it.
That's
That's what Mohammed told me. Bill Gross told me that years ago.
Don't know how they did it. I don't know how they're doing it right now, but tough. AMH, thank you. Anne-Marie down in Washington, D.C. Tom, and the latest out of China and the prospect, of course, at the end there of a meeting between the two leaders.
Yeah, and that's within this turmoil in China. I would suggest in diplomacy circles, November's tomorrow. So let's get to it.
Marilyn Watson of BlackRock coming up shortly on fixed income. Torsten Slock of Apollo moments ago publishing about the default cycle. We'll get into some of that too. Equity futures just about positive. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
4 days of SPX outperformance versus the NASDAQ. So basically the NASDAQ underperforming over the last few days. Equity futures on the S&P look a little something like that. Futures positive by 0.1%. At the moment, the outperformance back with the NASDAQ by 1/3 of 1%. The attention very much on big tech and the weighting of big tech a little bit later. We'll talk about those earnings in just a moment. In the bond market, 2-year, 10-year, 30-year, 2-year yields in 4 basis points. We're lower to about 487. Yields higher by a couple of basis points on a 10-year. Tom, this curve steepening a little bit today with a 2-year yield lower and a 10-year a little bit higher.
Very quickly, I know you want to get to under surveillance, but John, this is in your wheelhouse, and in Bloomberg off the London desk in Paris does talking about earnings season, not in big tech, but in big luxury. And there's some huge mystery there. I know it's not the size and the capitalization of big tech, but there's some real niceties there about the delineations of luxury, John, which you've mentioned with LVMH and the others.
Weakness in America, apparently. That's what we've heard from, I think, Richemont.
Richemont, which is Cartier, right?
Yeah.
They're the bracelet with the nail.
They do
like
watches as well. Yeah.
You buy a nail for more money than God.
Is that right?
They go to Home Depot, they just take a nail and
they
bend
like
it.
Screw it in. And
I don't know how you get it on and off your wrist, but
very fashionable.
It's
they were several years ago, and you see some people with them all up their arm.
Yeah, it's like a nail.
Okay, it's a nail. You've described it.
It's number 2.
Someone's just like,
yeah, you know, it's what you use with a 2x4. I mean, you know, it's.
Okay, I'm sure Cartier's loving this conversation. Let's finish on the euro in the FX market. 6 days of euro weakness continues. 110.44. We're negative 0.2% on euro dollar right now. Let's get to what's under surveillance this morning. Tech earnings ramping up with results from Microsoft and Alphabet after the bell. After the close, investors looking to see if the outlook for artificial intelligence can continue to justify just a monster run-up so far this year. You're familiar with the gains, but I think it's worth going over again. Microsoft up 44% year to date. Alphabet, call it Google, up 38%, Tom. What a move. What a move so far in 2023.
Big moves, and then you say, well, that's it, and that's the zeitgeist right now. I love how Dan Greenhouse pushed against that 10 minutes ago on the show, and it's a character of earnings, and of course, again, as in every sector, the conference call is everything, away from the AI, EIO idiocy. It'll be interesting to see what particularly Microsoft says just about the 3-year strategy, cloud, enterprise, the rest of it moving forward. It's a mystery.
Ad spend over at Alphabet, YouTube as well, given how competitive streaming is getting.
I'm not up to speed on Google other than they're the search engine, right? And we spent 10 years being wrong. The search, it's over. It's done.
I thought Bing was going to take over.
Bing, exactly,
Bing's
precisely. I used Bing once. It was like Threads. I went to Threads, went to Bing and said goodbye. I mean, that's the truth.
Threads, Instagram, Meta.
What else is under
tomorrow? If you want to understand the euro weakness, look at the data. PMIs yesterday, business confidence out of Germany. And look at this too. The lending survey published from the ECB today showing demand for corporate loans just dropping off a cliff, sinking the most on record in the second quarter. This rate hiking cycle, as you might expect, hitting demand for mortgages and consumer borrowing. But Tom, we're seeing a slowdown there. You see it in demand growth.
Yeah.
You see it in the economy.
The banking pros, Allison Williams and others, everybody talks about the drama, the stuff Chanel Bassett talks about. The bottom line is the nitty-gritty, the Brian Moynihan of it is, what are we actually doing with deposits? What are we doing with loans, net interest margin, and all that? This is on the loan side. As I mentioned in the last hour, to me, it's a hugely important overweight in Europe because of the bank loan fixed income nature of Europe versus the financialization of America.
European Central Bank decision on Thursday with President Lagarde anticipated to hike interest rates. The ECB story right now is not the same as the story at the Federal Reserve and the United States. It's just not. It's just become really, really different. And as someone pointed out to me a little bit earlier this morning, just to state the obvious, different mandate as well, singular mandate.
Yeah.
For the ECB, it's inflation.
Yeah.
Got to hit it. In the United States, labor market, full employment, inflation close to 2%, all of that good stuff.
I take the point on that. I think it's very, very important. But with that said, it's about, are they beyond Eurosclerosis? And this is what we talked to Gentiloni, the former Prime Minister of Italy, about at the IMF meetings. I mean, I don't hear anybody talking Eurosclerosis. We've moved beyond that, maybe to a better place. But is there a buoyancy to the entire game? I'm not sure.
Kit used SocGen this morning in his morning note, writing that if you want to see sustained euro strength, you've got to see something big coming out of China. My words, not his, but that's what he was alluding to. Stocks in China actually rallying today after pledges yesterday from Xi Jinping and the Politburo, the leading policy body over in China, led by, of course, Xi Jinping, to boost economic growth. So you've got the Hang Seng China Enterprises Index up by more than 5% in Hong Kong today, tracking those big Chinese companies listed there, Tom. That move, the biggest since November, and you remember back in November, that was around the China reopening story. So we've got a bounce there. Let's see if it's sustainable, and let's see what kind of stimulus we actually get from China in the coming weeks and months.
I would emphasize bounce. You look at it on a standard deviation basis, and it's not much of a move here. Yes, it is a bounce. And I'm going to suggest that we would hear from Endicott and Steve Engel and others reporting from China that you can't conflate the diplomacy, foreign affairs headlines of 20 minutes ago into an economic and finance analysis. I just don't think you can bundle the two together.
There's a lot going on there right now, isn't there?
Yeah, I mean,
big time.
It's crazy. Futures up for Marilyn Watson briefs now, had a global fundamental fixed income strategy at BlackRock. This is an incredibly important conversation, folks, on what the prescription is forward, which, Marilyn, is to be flexible and nimble. I'm going to editorialize into 2025. How am I flexible and nimble clipping coupons in fixed income?
So in fixed income at the moment, as you say, I think you do need to be flexible and you need to be nimble because it's a very uncertain environment still. At the moment, you can get very attractive carry at the front end of the curve still, also in commercial paper, in some short-dated investment-grade bonds. And at the moment, it pays to actually not take too much duration risk, not take too much risk, but just clip those coupons and get the income. But as the economy evolves in the US and in Europe and elsewhere, as we get more information, from the Fed tomorrow, from the ECB on Thursday, and over the next few weeks and next couple of months, as we continue to see more economic data from the US or from the Eurozone, which, as you mentioned earlier, has seen some pretty weak data in the Eurozone at the moment, then we will continue to see a shift both in the yield curve and in the opportunities that I think that are available. So at the moment, I think it pays to, get the carry, to not take too much risk, but then to be able to really deploy that dry powder when the opportunities arise.
I need to conflate in here, Marilyn, the news now, and it's Torsten Slok writing for Apollo, looking at loans. I mentioned loans in the previous hour. Is a mystery to me, the default rate of high yield and such. Is the market too complacent about what is to come in commercial real estate, what is to come in these strange leveraged loan vehicles, in derivatives within your world? Are we too complacent?
So I don't know that it's too complacent, but I don't think there's a very clear view on the trajectory of the economy going forward. At the moment, our core view is that there won't be a recession this year in the US. We think that the US remains pretty resilient, and while it is slowing, it remains on a pretty solid footing. And when you look at the commercial real estate sector, then it has already been negatively impacted by the very aggressive rate hikes, but as you say, perhaps not as much as some people may have expected. When you look at leveraged loans and elsewhere, you look at, high yield overall has performed very well this year. But I think at the moment, a lot of investors are still looking at really getting in, I think, in a bottom-up fundamentals. So there's a big difference between the different bonds and the different issuers that you can also buy within the high-yield sector, and the spread and the total yield that you can get there as well. But at the moment, I think there isn't really a consensus on the trajectory of the economy and how bad, if it's bad at all, it will be next year. So I don't know if it's complacent. I think there's just not yet enough data for the market to be able to tell.
Let's work through some of this work from Torsten Slok this morning. And Marilyn, good morning. Allow me to share the full quote. Markets are not taking the ongoing rise in default rates for high yield and loans seriously. Many investors argue that this is just normalization, or these are companies nobody has heard about. The reality is that more and more companies are defaulting because the cost of capital is higher. Higher cost of capital is precisely how monetary policy works, by making it more difficult to get financing. The Fed hikes are biting harder and harder, and all investors should have a view on how high they think default rates will go during this cycle. Marilyn, can you have a view on that today? And would that lead you to believe that you should back away from areas of this market which are going to face much, much higher funding costs when they come back to market in maybe 12 months, 18 months from now?
Yeah, I mean, I think you can. And as I say, at the moment, you don't need to take the credit risk in the high yield sector when you can get very decent carry elsewhere, much higher up the credit spectrum. I think also, when you're looking at your overall allocation, when you look at the equity market versus the high yield market, for example, we also like some of the beta in the equity market. So you don't need to take the risk there. You don't need to take the credit risk. So you can take a view. And our position at the moment, I would say, is relatively cautious. It's relatively, high quality. And as I say, we're being very nimble and we're really steering clear of too much duration risk, although we have added a little bit there. But we're also just being very, very cautious from a bottom-up perspective. And we want to know and understand exactly what we're buying in every single issuer, in every securitized asset, in every investment-grade bond. We want to understand exactly the fundamentals from a bottom-up perspective of the issue itself and of the sector as a whole. So I think you can take a view, and at the moment, we don't think it pays to take the risk further down the credit spectrum.
You mentioned there taking on a little bit more duration risk. Can you give us a little bit more color there? What have you been doing?
So we've added a little bit on the margins because, it is our view that the Fed, will hike again this week and then maybe pause. The Fed itself has indicated in the previous summary of economic projections potentially one more hike, but we don't know that yet. Obviously, we need to see a lot more data to see whether that comes through or not. But we have been adding a little bit more duration in the front end and the belly of the curve in the US. Also, in the Eurozone, we think that the ECB will hike again this week. They may hike again in September, but that's nowhere near a clear-cut scenario anymore, given the data. And we do think it now pays to take a little bit more duration risk, get a little bit more yield, and just to lock in some of those rates.
Not even the hawks on the ECB want to commit to anything beyond this week. Find that interesting. Marilyn, thank you. Marilyn Watson of BlackRock. Enjoy London, Marilyn. It's good to see you. TK, I think that's been an interesting story. The data in Europe's weaker. We've got a decision at the ECB on Thursday with President Lagarde. And ultimately, you've got some hawks on that committee. I think it was Klaas Knot of the Netherlands in the last couple of weeks, who won't commit to anything beyond July, which I think speaks volumes.
Yeah, I've talked to him often, the guy from the Netherlands, Knot, and he's very much more what I'm going to call Anglo-American within his central banking than a lot of the other people in the ECB. But again, it's going to be fascinating, and it comes down to the heart of the matter, to the Lagarde presser.
This Thursday. If you are just tuning into the program, welcome to the program. Equity futures on the S&P positive by 0.1%. Coming up at 8:30 Eastern Time, Stephanie Roth, the JP Morgan Private Bank, will break down some of the economic data we're looking for this week and look ahead to the Federal Reserve decisions, Tom, on Wednesday and beyond. I think September's the one. Again, not just the ECB, but also the Federal Reserve. It's not about this week.
Yeah.
It's about communicating what happens next.
Yeah, what happens next after Jackson Hole? And I'm going to take it out even further, John. November 1. You go from September 20 to November 1. There's this tradition that December meeting doesn't matter. I don't have a strong opinion on that right now, December 13th. But the combo, it's September 20, November 1. And it's not so much, is somebody going to get the call right or wrong? It's how they amend off of what we see tomorrow. How will Hollenhorst and Citigroup amend? Or on the other side of the coin, how will someone looking, for no rate rises at all, how will they adjust off a 25 beep assumed move yesterday?
That's the new window for expected economic weakness, right? It got pushed out from the start of the year into the middle of the year, pushed out to the end of the year. That's when student loan repayments resume, and that's the new spot for the bears.
Yeah,
back end of the year.
I like what Claudia Sam says, is would everybody just look at the data, and the data is very mixed nationwide, state to state.
We'll look at the earnings next. The General Motors CFO on this program from New York. This is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
what do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
China's about 15%, 1/5 of AkzoNobel's revenue base, so it is significant for us. What we're seeing is a market that is better than what we anticipated at the beginning of the year, but is not as good as what we and a lot of people thought it was going to be when China reopened in March.
He's not alone. That was the AkzoNobel CEO on China. China disappointing in many ways. The reopening boom that market participants were looking for didn't materialize. What are we seeing now? Some rhetoric to support this economy. And as we've written about this morning here at Bloomberg, potentially Xi Jinping throwing a lifeline to international markets. Equity futures this morning, and good morning to you, look like this on the S&P 500, going into earnings a little bit later on this afternoon, and a whole host of central bank decisions later this week, starting tomorrow with the Federal Reserve. Equity futures, Tom, up by 0.1%. Yields a little bit higher by a couple of basis points, 389 in the FX market, euro weaker. Bad data out of Europe again today, 110.47 for euro dollar. And some earnings in the mix before we get to Alphabet and Microsoft after the close later. The headline from General Motors in the last couple of hours, Tom, raising their profit target for the year by at least $1 billion, beating a raise.
Yeah, I remember, John, when you whispered to me somewhere in May of 2020, John, General Motors, Tom, General Motors, you got to do it. 20 to 60. And then a challenge last year, to say the least, and now ebbing and flowing here, 35 to 40. It has been a challenge for General Motors, including all manufacturers, through the pandemic, and now they look to profitability. Joining us, their Chief Financial Officer, driving the financial ratios at the complexities of the future of General Motors. Paul Jacobson joins us this morning. Paul, define profitability. Where on the income statement are you zeroed in on profitability out 24 months, out 5 years for General Motors?
Well, good morning, Tom, and thanks again for having us. It's always a pleasure to be with you, especially on a day like today where we're announcing the tremendous results that the GM team put forward. And I just want to extend a great big thanks to them worldwide for the results that they posted during the quarter. You know, when we're looking at profitability, you know, it's a whole range of outcomes. Obviously, EBIT matters, but one of the things I think we've been really focused on, and I think it's worked for us, is the combination of market share and margin and growth. So at the end of the day, it's not just about producing and selling more vehicles. It's about making sure that we're maintaining and expanding our margins going forward. And when you look at the track record that we've had, especially over the last 6 months, but really over kind of the last 6 quarters, the team's done an amazing job producing vehicles that customers demand. Right. And, you know, our biggest challenge is we can't get them fast enough, but customers have really responded, and we really appreciate that.
Okay, that's right where I want to go. And that there's a shortage of, you know, there's always in every company 4 or 5 vehicles. Everybody wants the same car. Do you have a lot of pricing flexibility now and into 2024? Can you raise prices?
Well, I'm not sure that we're going to be able to raise prices across the board, but one of the things that we've seen that has really manifested itself is customers demanding higher trim levels. In fact, we created over the last 18 months the Denali Ultimate, which was a higher end trim level than our high-end Denali on the GMC Yukons in response to customers wanting them. And now what we see when we look at our trucks and our SUVs, about 70 to 75% of them are being priced at premium levels where customers are demanding that. So I think we've done a good job of responding to where customer demand is and what they're looking for in our products. As far as the core prices, obviously the business is really competitive. We've focused on price stability, and I think our results show that we've done a good job of that.
John, a pickup truck. This used to be, you wanted an old GM pickup truck that you could drive around with your guitar next to you, and the whole.
Describing yourself as a kid.
You're down at Auburn University, and you get an old GM pickup truck that you paid $3,000, and you could see the road through the floor. GMC Sierra Denali Ultimate, ready? $91,900. That's what Paul's selling today.
So, Paul, are you telling us that you're expecting higher average selling prices in the second half?
Yeah, so John, we saw higher ATPs in the second quarter, about $1,600 higher than the first quarter sequentially. I think we're going to continue to watch it. We've taken this whole year with a little bit of caution, just understanding the macro that's out there. And what we said at the beginning of the year was, if the customer held in and we were able to maintain pricing, we expected to significantly outperform the guidance that we posted. And then after the first quarter, we raised guidance by $500 million on the EBIT line, and now we're raising it by $1 billion. So we see a lot of stability in the market. We're just kind of taking it one day, 1 month at a time, and watching the results come in. We've got to be focused on quality, and we've got to be focused on getting production in the vehicles that customers want.
Let's just talk about customers a little bit more. We saw some data recently, I think from the Federal Reserve in the last couple of weeks, about people being rejected for auto loans. Paul, can you give us an idea of how some of these purchases are being financed and the kind of trends you're seeing develop?
So, we've got a lot of good insight on that through our GM Financial captive company, and their results are pretty strong. We continue to write new loans. In fact, we've written at a higher share the first half of the year than traditionally, which is not a bad thing. We're there to meet our customers where they need us, and GM Financial has done a great job of that. We watch the credit metrics on a weekly basis across their entire portfolio, and we haven't seen anything that gives us reason for concern. We have really good high-quality borrowers on our new vehicles, and the credit is performing quite well from that. So we understand, obviously, in the subprime world and some of the used cars where we've seen banks tightening a little bit, that's not necessarily our forte, but certainly where we're lending on new vehicles, the results are pretty strong.
Paul, I'm going to pick on Itay Macaulay at Citigroup. In that, from the pandemic, from the end of 2019, I got a shareholder return of 3%, 4% per year. Whatever the number is, it's low single digit. Clearly, it's not acceptable. The fact is, somebody as knowledgeable as Itay Macaulay or the team over at Bloomberg Intelligence looks for huge share price performance from GM. What is going to be the catalyst for people to realize the new profitability of GM? What's the thing that's going to get me to Itay Macaulay's price target, which is a double?
Yeah, so that's the question of the day, Tom, and one that we spend a lot of time thinking about, obviously, for our shareholders. One of the things that we've got to do is we've just got to continue to consistently perform. I'm a big believer that the market can't ignore fundamentals too long. And when you look at the type of performance that we've been driving, I think we're establishing a really good track record of credibility. So that's job one. Number two, on the macro side, clearly it's been a bit of a headwind over the last 18 months as, expectations are consistent consistently downward from where we are, which is why it's so important now that we've put 2 quarters out there with a raise on the guidance. This year will be really, really strong. We're overcoming pension headwinds. We're overcoming some normalization at GM Financial's earnings. But, the results are going to be very similar, if not potentially better than last year. So that's what we're focused on. On the market, I think it'll come around. We've got to make sure that the macro clears up a little bit. I think we've seen that over the last couple of months. And, I think we've got to make sure that we reach an agreement with the UAW, not just for us, but as an industry, because obviously there's some uncertainty around that in investors' eyes. But we're focused on executing. We're focused on getting a deal that works for our people and rewards them for the tremendous work that they're doing across the board.
Paul, really unfair of us to save this question until the end because we only have a couple of minutes left, but I need to get this in. There are some subtle indicators worldwide that EV demand is tailing off. And I ask this question to you as a CFO. How do you manage the risk of a massive investment cycle and a huge push wholesale just going into EV not working out? And in 5 to 10 years, consumers don't want this stuff. We see greater efficiencies through hybrids, maybe even fantastic sustainable fuels. Paul, as a CFO of a car company right now, how do you manage that risk?
Well, John, I think it's a great question, but it's one that, when I look at the portfolio of vehicles that we have, really, really great internal combustion engine vehicles and a growing EV business off of a platform where we've designed EVs from the ground up. A lot of the EVs that are on the market are, traditional ICE vehicles where, companies have put a battery solution into it. And it's not optimized in that standpoint. When you look at the Ultium platform of vehicles where we're growing production very, very rapidly. Now, we think we've got vehicles that customers demand, and you certainly see that in our order books across the board. So one of the things that you haven't seen from us is the type of pricing volatility that many of our competitors are experiencing with some of those vehicles that were early to market. We think our vehicles, when you look at the Silverado EV, 40% more range than anything else that's out there across the board. We think we can win customers over the long term, but we've also got a very good ICE portfolio to fall back on, and it's driving incredible performance for us.
I said it was unfair. It was unfair because we need a much longer conversation about this in the future. Paul, appreciate your time, sir. The General Motors CFO. That stock this morning doing okay. From New York City this morning, good morning.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
so
destinations.
Functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store. so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
The real growth picture is pretty poor everywhere.
From an economic perspective, I think all of us expect a deceleration, a slower economy.
This is the environment where you have to be more nimble. We're cautious and think that the conditions are there for a full-blown recession.
I think we're gonna get a lot of clarity this week.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Abramowitz on assignment. She'll be here tomorrow for The Fed Decides. Look for our coverage, 2 p.m.-ish tomorrow afternoon, 1:30-ish. Who's keeping score? I'll show up at whenever they say, and we'll do The Fed Decides tomorrow. Right now, we decide that markets are lifting in the heart of earnings season. We've had a real focus here, yes, on big tech, but John, there's more going on there, including what we just heard from Generous Motors.
Look, we came into the year and corporate America was worried about a slowdown. Investors on Wall Street were worried about a slowdown.
Paul Jacobson.
GM have just raised their outlook for the year. 3M, Tom, a company you follow closely as well in the last hour, they've raised their outlook as well. So that's a bunch of companies with exposure to different parts of the economy raising their outlook. We saw it from the airlines, didn't we, a few times in the last couple of weeks too.
And what's important here is I don't think we heard the phrase AI from Paul Jacobson, the CFO from GM. 3M is fighting for their life here, but they got a nice $2 pop here this morning. Raise outlook top estimates. Cost cuts gain traction. Is that the view forward for the next 6 months? Do we see rationalizations, as they say?
So the question I would have, Tom, is if we do start to see a deceleration in growth, if we see further disinflation to complement the trend of the last month or so, the last couple of months, what does that mean for the earnings outlook? For top-line revenue growth, specifically, how does that work? And can they cut costs quickly enough?
The moving parts, and part of this is what we'll see tomorrow with the Fed as well. We've really focused on the ECB. Let's focus on the Fed right now, John. It's a snooze fest? I don't think so. He's going to pick up the paper. For those of you on radio, I've got my paper here, and Mike McKee's going to, Juliana Smilek over at the Times, they're going to ask some rude question, and he picks up the paper and he goes, da-da-da-da-da-da-da-da. Somewhere in there is going to be some direction.
2 more inflation prints between this meeting and the next meeting in September, and a Jackson Hole meeting as well. You can lean on the forecasts, a Jackson Hole speech, of course. I'm aware there's no Fed meeting. Forgive me for the slip of words, TK. I think from there, Tom, you lean on the forecast in the summary of economic projections, which indicate 1 or 2 more hikes this year, and you wait for the data between now and the next meeting
You
in
wait
September.
for the data. This is true, and it's true of BOJ with inflation running away. It's true of ECB with all the challenges, including German and, might I say, French slowdown is, well, they're massively data dependent, out of a pandemic. Maybe we're getting back to traditional economics. I don't see it yet.
Jackson Hole Symposium, I think, is the correct terminology.
So if we went to
A
Sintra,
symposium.
if we went to Sintra and Jackson Hole, took the entire team, the answer is we'd go to Symposia.
Is that right?
I think
don't know.
so.
Your English is better than mine. Let's turn to the price action, Tom. Equity futures on the S&P positive by 0.1%. A little bit of a lift in this equity market. Yields a bit higher by a couple of basis points. Your 10-year 3.8944 in the FX market. Just the weakness in the euro. Need to sit on it. Euro dollar 110.51. I know it's only one day today of about 0.1%, but it's 6 consecutive days of those kind of moves, and they add up. 6 consecutive days of euro weakness off the back of weaker European data, Tom. Bottom line, things aren't looking great on the continent.
These are trends in place, and they get ignored, like the Dow is up 11 whatever days in a row, and that's a broadening away from tech as well. I'm fascinated, John, by the double barrel of tech earnings out to August 3rd, which is Amazon and Apple.
Yep, next Thursday.
Double-barreled with, and granted it's smaller and less visible, luxury, which I believe starts today with Louis Vuitton. It's going to be interesting to see, the combo of high multiple tech, wicked high multiple luxury, and how they do.
After the close, LVMH.
Which close, though? Paris close?
I believe the European cllose, I think. But maybe I'm wrong about that.
Should you and
I
I
can
go over the 57th and 5th Avenue and maybe they'll report earnings from there?
Knock the door at Tiffany's and ask?
Well, no, Louis Vuitton's across the street. We can go there.
You want to go there instead?
Yeah,
Okay.
Well, I don't know. I haven't been in ages.
Is it still a thing? I haven't gone at all.
I'm not sure if it's still a thing. But they do have the Tiffany thing going, and that's been a huge deal.
That's been a big hit. Quite a transformation.
I don't know. I think we're going to find out in the earnings call if it's a big hit as well. Right now, we're going to get to this, and we're going to get to it with a congenital optimist. Drew Mattis is Chief Market Strategist at MetLife Investment Management. He has been wonderful about gaming the optimism of the American economic experiment. Drew, let's start with that. Glass half full, glass half empty at MetLife.
Well, the good news is there's not going to be a recession this year. The bad news is it's still coming. We've had to move back our forecast from mid-year to the start of next year. The reason we went that far, actually, is because we think consumers are still in this ball game. They're still in this you only live once mentality post-COVID. But we do think when you get to the start of next year, you'll have a lot of more headwinds. And some of the data now that's currently pointing towards a recession will probably be even worse. And we think the turn of the year is about the right time.
The raging economic debate, and maybe this will be alluded to in the academics of Jackson Hole, is whither R starred, whither the rate post-pandemic we're gliding to. MetLife is riveted to the actuarial return expected within longer-term portfolios. Have you adjusted that view? Have you lowered your expectations for return, or can you be more optimistic about a better return post-pandemic?
So I'll say this: when we think about, so let's get past the next recession, whenever that is, right? We think it's next year, but let's just say in the future. When you come out of that recession, what are you going to have? We're very optimistic there, and that means higher potential growth rates. We think that there's the potential for participation rate rebound, even beyond what we're seeing, higher productivity, although it's hard to get lower than we currently are, but we expect a rebound in productivity that's sustainable and will be sizable. And we expect, therefore, that potential growth will be higher. And with potential growth being higher, we expect neutral interest rates to also be higher at that point.
Drew, build that out a little bit more. What's going to drive higher that productivity, potential growth, higher neutral interest rates? Where does all that come from?
I think, so first of all, from kind of a worker perspective, I think you're going to have people engaging in the workforce for over longer periods of their lives. And during healthier periods of their lives. I think the healthy period of people's lives are going to expand. And I think that that's a consequence of some of the gains we've made in biotech during the COVID problem. So I think so that's first and foremost. Secondly, work from home will encourage older workers to potentially stay in the workforce for a little bit longer. And I think firms are going to respond to that by making it easier for older workers to stay in the workforce for longer. And so not only are we going to potentially have this rebound that we're seeing in kind of the so-called prime working age group, but we're also going to see other groups actually engaging more aggressively in the workforce. And that'll be good for the U.S. economy as a whole. Productivity-wise, I'm doing this from my office via Zoom, right? I mean, in the past, this would have been very difficult for us to pull off. It's just a much more convenient and productivity enhancing arrangement. And I think if you go through and look at whether it's the cost of putting objects in space, which has deteriorated significantly or lowered significantly, when you look at gains in kind of biotech, you know, for 25 years, we were promised miracles in biotech, and we finally saw some, and no one's paying attention, right? Because we were distracted by the fact that, you know, it was a crisis situation. But, you know, those things are all add up, and they'll all begin to interact with each other in ways that, you know, I can't probably fathom completely how they'll all interact, but they'll be productivity enhancing. And I think we're in for a big productivity ride once we get through this next downturn.
How rate sensitive do you think the economy will be that you describe?
You know, I think initially every economy is rate sensitive because you have to finance all this stuff. But I think, you know, in some ways, you know, the die is cast in some of these industries. You're seeing the deteriorate or the lowering of price and cost of getting things into orbit. That's already happened. And so, you know, I think for now it's just a matter of how do we exploit it best, and you know whether or not you know my forecast is going to hinge on kind of you know am I right or am I wrong, which I know sounds obvious, but I do think that you know the history has shown you should be optimistic for developments in technology, not pessimistic.
So then what does that give your GDP statistic out 1 year? I'm not talking about quarter to quarter or that. On a longer, broader term, you're in a meeting at MetLife where people's idea of short term is 10 years. What's your GDP run rate? Can you get above 2% real GDP?
If I had to put potential growth 10 years from now, I'd probably put it closer to 3 than 2.5.
Wow. 3 real percent real GDP.
I think that is a reasonable estimation.
Wow, that, John, that is a wow statistic from Drew Mattis. I can't convey how off norm that is. And that goes to the responsibilities of an insurance company where they're really focused every day on a long-term view.
So, Drew, can we finish on this just quickly? If we get a rate hiking cycle ending with a hike this week, let's just say that. Maybe you get another one, but who knows? Drew, when they start cutting, have you got firm ideas on what they cut back to? Because clearly there's a consensus out there that we don't go back to zero. What's your view on that currently?
I think there'll be a 3 handle at the low point for the next cycle.
Okay. And you think the bond market is well priced for that, given the way you see the yield curve evolving in the last few months?
I'm actually a little surprised at where the yield curve is, given this expectation that we're in you know, we're going to have a soft landing, to be honest. I think, you know, when you think about what a soft landing means, it means that the Fed probably wouldn't have to reverse course. So they're going to be stuck at kind of this 5% plus for a Fed funds rate. And so where should the rest of the yield curve be in that kind of scenario? And what should that yield curve be shaped like? And when I look at the current shape of the yield curve, I don't see that reflecting that belief.
2-year, 10-year, just around 100 basis points still. Negative 97, 98 this morning. Drew Mattis, thank you, of MetLife Investment Management. Some big calls there, Tom.
Big
about
calls,
the
John,
future of this economy.
I'm going to say in Q3 right now, you just saw the headline of the quarter, right or wrong, what Drew Mattis says there about a run rate of 3%. I'm going to hedge it, near 3% real GDP, John. That's an extraordinary statement by Drew Mattis with all of his heritage. In the future, long term, that's a run rate far beyond potential GDP as analyzed by a lot of smart people.
If you're just joining this morning, welcome to the program. Live from New York, your equity market positive by 0.1% on the S&P 500. Yields are higher by a couple of basis points on a 10-year, 389.24. The euro is weaker. We've talked tons about the weakness in the economic data in the Eurozone. Haven't talked a lot about Japan, Tom. So Japan with the BOJ decision on Friday, and we'll see what the outlook there looks like for inflation. So you've got all these little nuances starting to come to the surface. The difference between the Fed and the ECB, Wednesday, Thursday. Then the difference between the ECB and the BOJ, Thursday, Friday.
And I'd go all Damien on you and bring in EM as well, how EM bounces off the central banker to the world, Jerome Powell, and on the Pacific Rim, how they bounce off Japan and their unique experiment, to say the least. Foreign exchange is a litmus paper here. I've got stronger yen over the last number of days. days, 143-ish down to 141. But the answer is it's one big mystery. And I would go back with the slowness in Europe to the worry of the Japanification of Europe. I don't hear that in the zeitgeist right now. You keep this up for a number of months, you may get that.
You may get some real weakness. Germany in recession. And based on the recent economic data, they're not coming out of it.
The most important chart to me, John, is like nominal GDP of Italy is flatlined for a decade. Or, you know, I'm making this up as I go, folks. Stay with me. But the bottom line is the animal spirit of selected economies out there, including Japan. I mean, what's the why? Why is Japan doing YCC? They're trying to impute inflation into the system to reflate and jumpstart lousy nominal GDP.
A once-in-a-generation opportunity to do so. Tom, the other point in Europe as well, the weather getting so hot in parts of Europe. There's a real fear about maybe losing some of the tourist season on the continent.
There's no joking. This is really serious, and it creeps north off the Sahara, off the Mediterranean.
Equity futures on the S&P just about positive. Stephanie Roth of JP Morgan Private Bank coming up very shortly. She's joining us in about 20 minutes' time.
Going to keep rate World Cup. This is a 3
as the economic picture does. The BOK is getting ready to make.
3 prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Wednesday, the market expects another rate hike.
They're getting the message loud and clear. The Fed wants to go again.
The then what is the big mystery.
But will it be the last of the cycle?
Is it one and done or more to come?
Does the Fed make policy based on what they're worried about or what they actually see?
Trust Bloomberg for the fastest coverage and exclusive analysis.
Twice more is not too high of a bar.
The Fed wants all options on the table.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
Hopefully what they'll do is acknowledge that there has been some softening in the path of inflation, because that is factually correct. But at the same time, it's too early to call victory on the inflation fighting battle. And after that, what I think they should do is just leave all doors open so they can go again in November, or this can be the end.
That's a decent description there from Gargi Chaudhry of BlackRock on what most people expect from Chairman Powell and the Federal Reserve going into tomorrow's decision. Coming into today, the 2-day meeting commences down in Washington, D.C. for Chairman Powell and company on the FOMC. Your equity market going into it shaping up as follows on the S&P 500. Equities are higher by 0.1%. The earnings this morning so far so good. GM raising the outlook. That stock just about unchanged in the pre-market. 3M raising their outlook as well. That stock positive, Tom, by 2.7%. in early trading.
Thank you so much for bringing us up. Full disclosure, my mother grew up in Minneapolis, and we've had a heritage, a bias to Minnesota manufacturing and mining for years. John, on the ANR screen, which is a sell-side research analyst screen in the Bloomberg, 3M, such optimism. 16 holds, 4 sells. John, I've never seen this. A so-called blue chip company, this one deeply troubled. There are no buys. 0. There are 0 buys on 3M on the Bloomberg screen. I find that absolutely
I was totally
remarkable.
unaware of that.
Yeah.
That's amazing.
But that shows you the nuances here away from our silly fixation on Microsoft and Google, which you and I will be guilty of at 4:15 this afternoon. But that's what we're trying to do here, folks. Give you earnings season, earnings.
How many of those holds do you think are actually sales and are just maintaining a relationship
don't
with
get
management?
me going on this. And the current's going to be angry. Don't get me going. A hold is a sell.
Always,
I am in the camp.
I've always felt the same way. What does it even mean?
I have been in the room where the general counsel or the youngin to the general counsel says, we can't say sell, we got to say hold. A hold's a sell. That's where I am.
Or an equal weight.
Yeah, and David Balin at Citigroup would say
neutral.
I'm nuts or whatever, but there it is. I'm going to go to this. We're going to get to this quickly here, and then Enda Curran is going to join us here for a timely call. I can't say enough, John, about what we just heard from Drew Mattis. We begin the third quarter with the headline of the quarter. I'm sure there'll be other ones along the way, but the idea of the optimism there of, as you mentioned correctly, John, productivity lift, technology success of America to 3% inflation-adjusted GDP. That's a lonely call of optimism.
And the Federal Reserve, if they do cut, Tom, he believes they only cut back to, say, 3. And we have to get used to a world of 3% and above, which is the old world, right? You know, the last 15 years have been an aberration.
The surveillance talking point out to Jackson Hole. Right now in China, and we will do what we do best, is rip up the script with an expert. Enda Curran is global economy correspondent in Washington for Bloomberg News, but encyclopedic on his pandemic tour of duty in Hong Kong. We're thrilled he could join us this morning. And do you link in foreign minister upset in Beijing to the economics of finance the investment challenges of Beijing?
It's an open question, Tom. I don't think anyone has any real insight. As you mentioned, the replacement of Qin Gang as foreign minister, that does end a month of speculation. We had a very extraordinary situation whereby China's foreign minister disappeared from the world stage. He was replaced by Wang Yi, and that seems like that's what's going to continue from here on. We don't know how long Wang Yi will remain in that job, or if they'll name somebody else as foreign minister at some point in the future, but certainly we had that snap meeting last night of the Politburo. They've decided that the foreign minister is out. He's out, and we don't yet know why, Tom.
And John and I have such respect for you. I'm going to float this question. It's grossly unfair. Anne-Marie Horton brought up beautifully the backdrop here. It mentioned in some way extramarital affairs or whatever. Do you think those kind of personal or social matters folded into this debate, or was this more discreet and about professional foreign diplomacy?
Well, personal conduct can certainly be cited against officials. We've seen that in past corruption cases when the readout has come after their conviction. Personal conduct has featured in that. We don't know if that's the issue in this particular case, Tom. Certainly it's been central to the speculation. We all know that. It's been widely reported and on social media. But there are observers who say, typically speaking, that might not be enough to knock off someone of such seniority. And remember, Qin Gang rose up through the ranks very quickly. He was seen as being quite close to President Xi Jinping, so there's double surprise that somebody like that would fall from grace so quickly.
And let's just build out what we did hear from the Politburo on the economic side yesterday. I saw a series of headlines about doing this, that, supporting consumption domestically, saying all the right things. Can you get your hands around any firm policy measures that have been announced in the last 24 hours that can have a material effect on growth?
It's a little light on details, John. I think people are seizing on the idea that they dropped a statement that houses are for living in, not for speculating. That's the first time since 2019. So the thinking there is maybe they're easing up on the crackdown on the housing sector, which they already have been, and they will allow perhaps developers and others to get on with building more houses there, and that will obviously partly at least reflate the real estate sector. So some people seizing on that phrase, perhaps some
some better news for the real estate side of things. On the consumer side, a lot of focus on boosting confidence, but as you say, short of specific hard measures, there was talk of selling more bonds or expectations of selling more bonds at local government level to build infrastructure. But there's also commentary in the Politburo readout about needing to control debt, local government debt. So expectations there for maybe restructuring and debt swaps. So I think mixed signals, but the big takeaway seems to be it's on the dovish side. Whatever they're planning will probably be enough to maybe get the economy to hit that 5% official growth target, but certainly nothing like the stimulus of the go-go years. And it would be wrong, I think, to expect we were talking about a stimulus like post-08 or maybe around 2015, for example.
Pushing on a string is a phrase we heard a lot in the last couple of decades in several situations. And a balance sheet recession would be something new and widely anticipated by many people for a long, long time. And did you see any evidence whatsoever that a balance sheet recession is occurring in China?
Well, it's certainly become the talking point of the moment. I mean, there's no doubt that there are some similarities with what went on with Japan, John. But you have to say there's still a lot of potential. One of the key defences for China's economy is that it has not yet hit its economic potential. Look at the potential for the middle-class consumer, the urbanization story, that hasn't gone away. So that's what a lot of the defenders are clinging to in terms of where China's economy goes from here. But structurally, though, the demographic story is certainly leaning against it. The debt story is leaning against it. And you'd have to say that, at the very least, the government has a big job on its hand now to try and turn things around in the coming months.
Big job. Enda, thank you, sir. I know we're going to catch up a little bit later. Looking forward to it. Enda Curran there of Bloomberg on the latest down in Washington, D.C. Spent a lot of time in Hong Kong. A deep understanding of the economy there and the Chinese economy as well. It's going to be a key focus for us in about 25 minutes' time. We need to talk about the difference right now between what's emerging in China as they push a stimulus effort, in Europe as they try and contain the fallout from a recession in Germany, and in the United States with all the hopes and dreams of a soft landing engineered by this Federal Reserve. We're going to do some of that with Mike Collins of PGIM. We'll speak to Tiffany Wilding of PIMCO, Mark Mahaney of Evercore on the earnings from Big Tech a little bit later, and Christian Mamani of Lafayette College. Stellar lineup, Tom, going into the opening bout
important
in about 35
lineup,
minutes.
and really must listen for those of you going into technology earnings here. Mark Mahaney, I've known for ages, and he's just bulletproof on basic securities research 101. He's not someone bedazzled by AI. You know, I just don't see that.
He's not counting how many times they use
he doesn't give it. He's seen it all before.
They use the phrase, the acronym a little bit later.
Back at Citigroup and, over the years, RBC now, and Evercore ISI. I mean, this guy's, like when Ed Hyman's standing at Evercore ISI going, what do I do with Apple? That's who he turns to, Mark Mahaney.
We'll turn to him
that simple.
A little bit later.
And Julian Emanuel takes notes.
Do you think Julian takes notes?
Julian takes notes when Mahaney opens his mouth.
Okay.
What's great about Mahaney is he can take a Fender Precision bass, play it totally differently than a jazz bass.
He's a guitarist.
Yeah, bassist. Come on, there's a difference.
Nice. Isn't bass easier?
Yeah, bassists get the girls.
But bass is easier, right?
No, don't.
I thought bass
John,
guitarist.
That's a folks' spa. Mahaney's going to cancel on you.
Bass is what you played if you weren't musically gifted, but you wanted to join a band. So you just played bass. No, if I got that wrong.
You got that so wrong.
I thought that was the case.
Mark, don't cancel. Mark, don't cancel, please.
Is that wrong, really?
Don't cancel.
Come on, be honest. I thought that was the case. No, I feel like you're lying to me. Futures on the S&P, just about positive. Good morning.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it. They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Bloomberg Surveillance, we say good morning to you. A really eventful day. We're going to go into an important day. Later this morning, out of Paris, you're going to begin to see luxury in France. And it has been a boom stock environment for Louis Vuitton, Hermes, and the rest of them. And we'll see what they do forward here. And then we go on to tech earnings this afternoon. Look to Romain Bostic and all that we're doing on Bloomberg Television and Radio this afternoon in the tech earnings. Before that, we're going to get a 30-minute pre-brief here on the economics of the day and the housing data. Case Schiller, I'm more interested in 30 minutes. But right now, a statistic, Philadelphia Fed non-manufacturing to provide brilliance. Michael McKee.
You can't add a lot of brilliance to the Philadelphia Fed non-manufacturing.
Is that a service sector index?
It's service sectors. It is not nearly as old as the manufacturing index. And, of course, the regional indexes don't make as much of a difference.
Right.
But 1.4 is the number. It was negative 16.6 before. This kind of flies in the face of the other service industry numbers we got this week, the S&P Global PMIs, because those went down a little bit. But you know, there's so much going on in the economy right now, Tom. I can't imagine that this adds anything to the Fed's knowledge.
Was this number adjusted because Bryce Harper played first base for the Phillies the other night? Shocking to see.
Probably
had something to do with it.
Well, I mean, when he tumbled, that was a...
You and I would go to conferences and the joy of Carl Case of Wellesley, the late and hugely missed Carl Case of Wellesley College, Mr. Schiller holding court at Yale. We've got Case Schiller coming out here at 9 o'clock. I'm sort of thunderstruck by a negative statistic on one of the series, flat on the other series. Do you presume that we will get negative 12-month trailing statistics on housing?
I haven't done the math on that, but we could get there. It's a difficult issue because they do a 20-city survey and they do a national survey, which is extrapolated out from that. And so individual housing markets are different, as we've seen over the years. So it's hard to know where we end up. The thing that has surprised everybody was the lack of demand because there's no houses for sale. And so lack of supply means your price tends to go up. In this case, they're starting to come down or at least flatten out. And that is probably more what the Fed is looking for when it's pushing up interest rates.
Let's get out to the Fed decides tomorrow. It's tacky for me to say what question and he asked Jerome Powell and all that. What does he not want to talk about? What's the thing he wants to avoid in the press conference tomorrow?
Well, he always wants to avoid the R word. They will never say recession. The minutes have shown that the last couple of meetings, the staff has forecast recession. And when asked about it, he sort of sweeps it aside and says, I don't want to talk about staff forecasts because he doesn't want to be on record as saying anything to do with recession. So watch that. And then he obviously does not want to say anything about what they're going to do or whether the committee is divided over what they're going to do at the next meeting.
You know, the one thing I wanted to bring up here, and it's going to be a constant theme for me, I'm going to wear you out on this, Michael McKee, and we'll talk to Stephanie Roth about this in a moment. Drew Mattis at MetLife, with his optimism, the inherent Mattis optimism learned with Maury Harris years ago at UBS, hit me over the head with a 3% real GDP outlook long term. That MetLife short term is 5 years view, a huge optimism. Do we need a massive boost in productivity to get to the Mattis optimism?
We could need that because at this point, we're not sure where the labor supply is going. Yeah. It's been growing, and we're seeing more immigration. Does the labor supply continue to grow to help boost potential growth? If not, you're going to need something on the productivity side. Now, as I said a week ago, I was out in Wyoming at this conference with a bunch of CEOs who were all saying it's still hard to find workers and it's hard to find qualified workers, so we're putting more into automation. And at some point, you would think that shows up in the productivity statistics, but it really hasn't yet.
McKee, out in Wyoming for this conference, in Idaho for that conference, what a life. She's jealous. Stephanie Roth joins us, senior market economist at JP Morgan Private Bank. I got to rip up the script here, Stephanie, and you can do this with a great combine team at JP Morgan. There's potential GDP, which is a pretty moldy number based on demographics and all the rest, the toxic brew, as Lisa would call it, of our economy. And then there are growth optimists out there. I think of Neil Dudd at Renaissance and obviously Drew Mattis at MetLife as well. Can you be a growth optimist?
I think it's hard to be that optimistic on growth. The number like 3% sounds quite optimistic to me. That said, the data that we've seen on the labor supply front has me a bit more optimistic than we've been. I mean, the immigration trends that we've seen have been really quite positive. We've added the combination of that plus female labor force participation picking up has added about 1.5 million people above what we had expected this year.
I look at your background of Bucknell, prodigious math, and your statistics work at Columbia. You bring a whole different template to economics as well. Do you have confidence in our data right now? Do you have confidence in your probability distributions looking out 1 year, 2 years, 5 years? Do you have a statistical construct that you can believe in?
I have to say honestly, no. This has been one of the periods where it's been hard to have confidence in the data. You've had incredible revisions. You've had seasonal adjustments that have been very, very difficult to adjust since the COVID pandemic, and that's resulted in massive data revisions and incredible uncertainty. So between the uncertainty, the data having a lot of issues and significant revisions, and then on top of that, your models don't really work following COVID, I would have to say you have to be quite cautious about your outlook.
I'll throw one more thing in there that we haven't really started talking about yet, and that is the impact of labor strikes on the employment numbers, because we won't get an accurate count of the artists and writers and actors, because the actors didn't go on strike until after the reference week, and then we don't know what's going to happen with UPS. So we could have really messed up labor numbers. So it makes it harder for the Fed, which is my long way of asking a question. If your models don't work and you don't have a lot of confidence, how do you know that we might go into recession, and how would you put together a rationale for a vote one way or the other if you were on the Fed?
Everyone has been using history as a guide. So generally speaking, when the Fed hikes rates 500 basis points, you see something breaks. And I think that's what's gotten a lot of economists off sides in this cycle. Is history would tell you we should be in recession right now, but clearly the data have been conflicting with that. And we over the course of this year, we've had to become a little bit more optimistic, just because the data have come in more resilient. You're seeing housing start to stabilize. So our base case is you still get a slowdown, but much more mild than what we had thought a couple of months ago.
When do you think that shows up? This quarter?
I think you get a continual slowdown throughout the course of this year, and then in the first half of next year is really when you start to see more sluggish growth, somewhere around 0%.
I look at how you dovetail your economics into, like, what do you do with investment right now? Do you have an outlook on the broader American economy that gives you as an economist an outlook on equity markets?
I think what we can feel good about is, yeah, the markets have rallied this year, but for good reason. Inflation has come down way more than anyone had anticipated. We're now looking at inflation that's trending around 3%. which is not the 4 to 5% that we thought we were a couple of months ago. So that tells you, yeah, maybe markets have certainly rallied, but there are parts within the markets that look attractive. So for us, that's mid-cap equities or European equities, where you have valuation support in an environment where the fundamentals are still okay, and we're just avoiding some of the names that are particularly overvalued.
Okay, but this is critical then. And I don't mean you personally, I don't want to get you in trouble with your compliance, but at JP Morgan Private Bank, if you were lucky and own these tech stocks, do you maintain ownership of them? I'm not talking buy, hold, sell. I'm talking more as a cosmic event. I own this stuff. Do I sell it and go to the value proposition, or do I keep it but new money deployed to the value proposition?
Yeah, we're a lot of our clients are very overweight tech stocks, so we're very comfortable there. But we would add new money to some of the other areas with like mid caps or an equal weighted S&P index.
What are you doing telling people about investing overseas, or we don't want to say overseas because you could invest in Canada, be foreign, but with the UK in deep economic trouble, with the Eurozone behind the U.S. in terms of growth and unemployment, is it worth it to venture outside the borders at this point?
When we look at our proprietary data of our clients, they tend to be very, very overweight U.S. So for incremental dollars, we are suggesting that they add a little bit of money overseas, and one of our favorite places would be Europe there. You are starting to see inflation come down a little bit. Valuations are supportive, and earnings growth should be pretty good. So that's kind of our favorite area. And then we do talk about Chinese equities, but a lot of our clients are a little bit hesitant to add money there.
I want to get back to your core abilities, which is statistics, the analysis of all this data as well. Speak to our viewers and listeners about how you interpret the data veracity of American labor data, BLS, Census Bureau, and the rest of it. Is it good data?
Yeah, I mean, I think the data is good. We have to take the data that are given, because that's
well,
what
I
we
know
have to
that. You
analyze.
say that about China as well, and look where that got us. But in America, do you trust the data?
I trust the data. I think we just have to be cautious that they're heavily revised. Pay attention to the seasonals, and then look at a broad skew of data. Don't just follow one indicator. And generally speaking, it's telling us that the labor demand has softened some. Labor growth has slowed. Wage growth, we'll see what happens on Friday with the ECI, but there's good reason to believe that we should see a bit of a softer print here, especially since the core services CPI, to the extent we can glean something from that, and that's labor sensitive, that has cooled quite a bit.
With the immense sway of James Dimon, can you talk to Mr. Dimon about getting the lockdown back in place in Washington so McKee can go down and sit in that little unair-conditioned room and get like the old days where like we actually get the data?
Data in advance.
I mean, you missed that, right? Instead of this delay at 8:30 that we get now.
Oh, absolutely. We would much prefer that.
Right. Stephanie Roth, thank you so much. She's with JP Morgan Private Bank, just really bringing a really twisted interpretation of our economics to us with statistics as well. On the data front, I really want to go through this because I think it's absolutely fascinating in earnings, and I want to make clear that in terms of the visible earnings that are out there, it really begins, I'm gaming here, 3 hours is my guess. Don't help me with the summer time zones and that. But we're going to get a Paris shutdown, and you're going to first see LVMH come out with earnings, I believe, at about 11:30 our time, maybe 10:30. But later this morning, let's go with that to be safe, you're going to see a first big earnings from a dominant provider in one of the go-go stocks of the moment. The two-year yield, 4.87%. SPX elevated up just 0.1%. We welcome all of you here on a Fed Day. Michael McKee with me as he travels down. When do you go down? I mean you're not going to do this by Zoom, are you? I mean, you're going to go down there.
Those days are over now. Yeah, I'll be going down this afternoon.
Well, how do they pick the questioning of it? Do you know in advance when you're going to get called?
No.
Is there a rhyme or reason to it?
The chief of staff of the Fed is the one that calls on you, and basically their model is to call on the major print publications first, and then they call on the TV people.
Why do they do that? I mean, that's
a good question.
Grossly unfair.
We should send you down there to, make them listen.
It's just, but that's really how they do it. They call on print first, just out of a tradition.
Yes.
When he reads a statement off, do you make note of he's reading a prepared statement? Is that important that the answer is so important that he has to read a prepared statement, or is it not a big deal?
Well, it's a big enough deal. You want to know what the rationale was, but a lot of it is word for word what's in the statement. You're listening for anything that is additional or on top of that, and you're listening while you're looking at your list of questions because you want to make sure he doesn't answer a question in his opening statement.
I mean, it's fascinating to me how there's a question. How many times has it happened to you where you've got like 5 questions lined up and Smilik of the New York Times asks one and Leisman asks one and then Leisman does a follow-up and then the Washington Post
happens
asks
all the
one.
time, which is why you go in with more than 5 questions. And then, of course, when they put out their surveys or their statement, there's always questions that arise from that as well.
I will state, folks, that under pressure, this is not easy. The first time I saw this was with the great Simon Kennedy and John Snow, and let me tell you, those press conferences are power-packed. We'll have our coverage for you tomorrow. The Fed decides, and look for that. Please stay with us. Futures red and green on the screen, I should say. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Moment news breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI semi sort of trade here.
The $69 billion deal is the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
I'm critical of Powell because, as you may know, they use a portion of the data they use is quite lagging. And they didn't see inflation when it was here. And then when they showed up late and big. They went straight vertical on rates. We had to increase rates. We should have done them much earlier. He shouldn't have had negative interest rates. He shouldn't have been buying mortgages into May of 22. That should have stopped so much earlier. We didn't need him to do that. But when he finally stopped, he went the other direction, and he went so far, so fast. And I'm saying, just wait.
Always timely, but now never more so with what we see in commercial real estate. Mr. Sternlicht, Barry Sternlicht, Starwood Capital Chairman and Chief Executive Officer. This is a conversation, Bloomberg Wealth with David Rubenstein. The interview is tonight, Bloomberg Wealth at 9 p.m., and I can't say enough about looking for this on Bloomberg Digital and on YouTube. We're building out our YouTube abilities. A lot of people going to YouTube, and look for that. Barry Sternlicht with David Rubenstein. Now joining us, the David Rubenstein as well with the Carlyle Group, and of course his work for Bloomberg Wealth as well. What a timely conversation, David. What did Barry Sternlicht say about the commercial real estate debacle to come?
Well, he thinks it's going to be a hurricane, kind of a Category 5 hurricane. What you have is a combination of people not going back to work physically, and people really, because of higher interest rates, not valuing buildings as much as they
used to. So the result is you have an enormous amount of commercial office space in this country that's worth a fraction of what it was supposed to be worth. And at some point over the next couple of years or so, Barry Sternlicht would say, and others would say as well, this real estate is going to have to go into default in some way or another. The banks are not going to be able to really justify the debt that they have on the buildings, and the landlords aren't going to be able to pay the debt. So you're going to see a very large effort to, I'd say, sell a lot of this debt at discounts, and it's going to cause some problems in the banking community and the real estate community.
There's a suppleness to Barry Sternlicht's career, folks. If you're just joining us, this is the conversation of the day. I'd like to say to Mr. Rubenstein that we'll extend this discussion for 1 hour, but John Farrell would be upset by that at 9:00. David Rubenstein, this is so important. Who is Barry Sternlicht, and why do people like you lean forward?
Barry Sternlicht is one of the major forces in the U.S. Real estate market. He built a very large company in the commercial office building and commercial real estate world, but he also built a large hotel company. He ultimately sold that to Marriott. But Starwood Hospitality was for a long time one of the largest hotel companies in the United States, consisted of major brands like Westin and Sheraton, among others. He also invented the W brand, which is now owned in effect by Marriott. But even when he sold all that to Marriott, he kept his real estate company, which is now one of the largest in the United States, and it owns enormous amounts of properties across the spectrum of real estate properties. And he would say a lot of it is struggling. He has turned some buildings back to the lenders, as most real estate developers and owners of real estate are beginning to do, unfortunately. And so he made his name, I would say, initially in the late 1980s buying distressed real estate from the RTC. And I suspect he thinks there's going to be a lot of distressed real estate in the next couple of years as well. Hopefully, he hopes it's not going to be his real estate.
Well, okay, but distressed real estate, David Rubenstein, clearly means the Japanese show up. We're beginning to see that Cranes, C.J. Hughes over at Cranes, writing out new Japanese interest in the island of Manhattan as well. Will history repeat itself in our commercial real estate debacle where the foreigners show up?
Well, usually what happens is foreigners show up before the debacle occurs, not after the debacle occurs. Right now, I think you're seeing a slow diminution in values in office buildings. Anybody who's watching this show knows that when you go to a major office building in New York or other major cities these days, you don't see a lot of people there. And therefore, eventually, the people using that real estate are going to say, I don't need as much space as I used to because people are working from home 3 days a week or 2 days a week, and therefore I'm going to shrink in my next lease the amount of space I have, and therefore you're going to see enormous shrinkage in I think the usage of office buildings, and as a result, the values of the leases are going to go down, and as a result, the building's property value is going to go down as well. In some cases, the banks are going to be forced to take over the building because the landlord can't afford to service the debt any longer. This is going to take place over another 2 or 3 years or so.
Is Barry Sternlicht an optimist on, I guess, the durability of work from home and the migration of commercial real estate office to individual residences? Does he think we can pull that off?
I think he thinks we're not likely overnight to be able to go right back to the 5 days a week and using all the space we used to. And so I think he's quite cognizant of the fact that the world has changed in the United States. Outside the United States, he would say people are going back to offices, and it's not quite the phenomenon we have in the United States. For a number of reasons, in the United States, you don't see people going back to the office 5 days a week, with very few exceptions. But he's a very talented real estate investor.
Right.
I've known him for quite some time. And he also moved his entire operations from the Northeast to Miami, ahead of everybody else moving to Miami. So he was ahead of the curve there, as he is in many other areas. And I think he's operating quite effectively down there. His company now has over $100 billion of real estate properties. And while he has given some of them back to the lenders, on the whole, I think he's in pretty good shape.
Barry Sternlicht on the hotel business. Of course, Starwood is iconic there within hotels. What did he say about the future of hotels? All I know, David, is every time I call a hotel, the price is dramatically higher than it was 12 months ago or 24 months ago.
Well, because they know you're going to stay there, they probably are jacking up the rate.
Thank you.
Because they're sure you can afford it. But I would say that the hotel business is coming back from the depths of the COVID period of time when essentially nobody was using hotels, and the stock prices of hotel companies were way down. Now hotels are coming back because we're seeing in the United States enormous amount of spending on discretionary travel, on discretionary going away from home kinds of things, restaurants, amusement parks, hotels, and so the spending is up quite nicely in that area, and hotels are coming back. He's not so much in the hotel business as he was, but he's a leading light in terms of his thought processes, and he's really helped create a number of brands, not only W, but he also created the Baccarat Hotel brand as well.
David, in the time we've got left, I've got to bring up a bombshell interview earlier this morning. Drew T. Mattis was iconic at UBS with Maury Harris. He now holds court at MetLife. Drew Mattis, with exceptional optimism on the American economy, looked for long-term growth that would approach 3% real GDP. That's a hugely optimistic view out of American exceptionalism. Do you share that optimism that we underplay what our real GDP growth is?
Real GDP growth probably around 2% or 2.2, 2.3% is probably realistic in the current environment. I think 3% or greater real GDP growth when inflation is still reasonably high, I think is quite a high growth. Because if you have 3% inflation and you're saying 3% real growth, that's really 6% GDP growth the way it's measured. And I think that's probably not likely in an economy of our size. We did grow at 6% at one quarter after after COVID because we were so low. But right now, I think economies of our size, real GDP growth, 2% is probably realistic.
David, thank you so much. The most timely interview I've heard with Barry Sternlicht. You'll see it tonight on Bloomberg Television. Barry Sternlicht of Starwood with Mr. Rubenstein of the Carlyle Group. Bloomberg Wealth at 9 p.m. Tonight. And again, I really can't say enough about our digital distribution of this. We're really putting a lot of effort into what we're doing at Bloomberg.com and also out at YouTube. We're blowing up our YouTube site to make it more accessible and more user-friendly. Accessible as well will be the Fed Decides. We're going to do this tomorrow. Lisa Abramowitz is rumored to be on the Gulf Stream right now. We believe we will get her in back. I'm not sure if Lisa will be back for the show tomorrow morning, but I'm told that her people say she'll be here for the Fed Decides. I will start that at 1:30. Maybe she'll slip in before the 2 o'clock start date. And of course, we'll have the press conference of the chairman of the Fed with our Michael McKee in Washington as well. Red and green on the screen, just simply a churn waiting for those Microsoft and Google earnings. You'll see those this afternoon. Luxury out here in a couple hours. Stay with Alex Steele and all of, I don't know if Alex is not here, I don't think. Alex is like off, someplace where I should be. She's off, doing something cool. Anyways, 10 to 12 noon today, you'll get some luxury earnings out of Paris as well. The VIX 13.98 shows some of the optimism on the market over the last 3 or 4 days. On Bloomberg Television, very important, Pierre-Olivier Gonache, chief economist at the International Monetary Fund in the 10 o'clock hour. Good morning.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority. Venture capital, it's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to
startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
In many ways, the week begins today. Big Tech reporting after the close, live from New York City this morning. Good morning, good morning. Your countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Xi throws markets in China a stimulus lifeline. Europe's economy is looking worse, not better, as the Fed attempts to secure a soft landing. We begin with the big issue, global divergence.
There's definitely divergence when you look across the major economies.
Divergence globally.
Different economies are starting to diverge.
When we look to the U.S.,
there has been promising signs in the data.
The soft landing scenario is definitely being discussed a lot.
Any potential recession is still a ways off.
Growth, I would say, is holding up much better compared to Europe.
European growth is kind of flat.
We've seen the data weaken quite materially.
Weaker manufacturing activity.
Europe is definitely weaker.
For European risk assets.
I don't think it's a great setup.
This isn't a great setup. What we've seen, from China is this constant China headline development of more stimulus.
The China recovery story has done really nothing.
We shouldn't bank on China really lifting all boats.
Joining us now to discuss PIMCO's Tiffany Wilding, PGIM's Mike Collins. To the two of you, thanks for being with us. And Tiffany, first to you, just how much of a split are you and the team at PIMCO seeing emerging here between the United States, Europe, and China?
Yeah, well, the PMIs have definitely, started to diverge, with Europe being a lot worse. Now we knew that China also, there was going to be downside risk. I think the key issue with China is stimulus that the policymakers are going to input into the economy. Does that sort of lift all boats? We think probably no is the answer. It's going to be much more targeted, and there's much more wiggle room for downside risks on Chinese growth moving forward. Now, despite all of that, the global weaker global backdrop, the United States actually looks it has been looking relatively resilient here. So, certainly interesting dynamics happening in the global economy.
It's an amazing backdrop right now. Mike Collins, we've got this amazing situation where we're talking about the Fed engineering a soft landing, Germany in recession, and China needs a stimulus effort. What are you focused on this week?
Yeah, the divergence everybody's talking about, Jonathan, I think is going to be really hard to be sustained, right? At some point, either Europe and China will have to bottom out and recover, or I think the U.S. will likely be dragged down a little bit, but we're really focused on the bottom up. What is happening with corporations? What is happening with consumers? What is happening with activity from the bottom up? And so far, again, in the U.S., the signs are still pretty good. There are probably more companies that are doing well. GM just reported this morning, right? And they just keep raising prices on cars. They're increasing their forecasts. I mean, there are big parts of the U.S. economy that continue to show this tremendous resilience. So that's really where the rubber meets the road.
Housing recovering. You mentioned GM raising their outlook. 3M a little bit earlier this morning raising their outlook for the year as well. Tiffany, when it comes to U.S. economic growth, have you been raising your outlook for this year and beyond?
Yeah, I mean, certainly things have looked a lot better than we thought they would at the beginning of this year. But I would say, though, that the U.S. economy does face some headwinds into the back half of this year. The first one is just the fact that student loan payments are going to restart. We've seen some research that suggests that the people that didn't have to make those student loan payments actually took out more debt, thinking they never would have to. So those are increased interest cost burdens that the consumer is going to have to weather. And the other thing is that, although regional banks, reporting season has been relatively good news, still credit creation from these regional banks to the broader economy is slowing. And that's going to weigh on the small and mid-sized businesses, which are the growth engine, from a labor market perspective. So we think these things are in the back half of the year going to, they're still going to weigh on the U.S. economy and result in it slowing.
Demand for corporate loans over in Europe just dropped off a cliff. We saw that in the lending survey out of the European Central Bank. We're seeing this from the IMF just moments ago, raising their outlook for global GDP. Bloomberg's Mike McKee has the story. Morning, Mike.
Good morning, John. Yeah, we do have some new numbers from the IMF as they nudge growth up around the world. Not everywhere, though. The United States not doing as well in 2023 as they had thought. But here are the numbers. The world growth is going to come in about 0.2 higher in 2023, 3%. U.S., though, is only at 1.8%. And look what happens in 2024, a real slowdown. Talk about diverging growth, because the rest of the world grows faster for the most part. China a little bit slower, but for the most part, the rest of the world is going to grow faster in 2024, according to the IMF. Now, does anybody care what the IMF thinks? Not down at 20th C Street. The Fed is going to make its own decisions about what's happening. But here's the difference between what the IMF sees for the U.S. economy and the Fed. And I threw in the Bloomberg Economist survey from earlier this month. And you can see the IMF is much more optimistic about the U.S. for 2023 and about the same for 2024 as the Fed. But the economists are more optimistic and much less so for 2024. Makes for an interesting discussion as they get ready to do their rates. And then you can take a look here at what the Fed thinks in terms of the inflation rate going forward and the unemployment rate. Fed is much higher in most cases, except for in 2024, economists think we're going to see a much higher unemployment rate. But at this point, the Fed has all these numbers to deal with, and as Tiffany said, the possibilities of a lot of things going wrong in the back half of the year. So it's going to be an interesting meeting. They don't put out new forecasts, but it'll be interesting to see what Jay Powell has to say about it.
And that's the key caveat with the IMF forecasts all the time, Mike. You read them out and then you say, does anyone care? Mike McKee on the IMF forecast from the International Monetary Fund, raising their outlook for GDP, for the global economy. Some subtle nuances between different regions and countries, of course, there always are. Tiffany, you talked about the prospect of weakness in the second half, and student loan repayments are something a lot of people are focused on too. We've got this deceleration, this disinflationary trend in the backdrop as well, in the background. And Tiffany, I wonder from your perspective, can you identify just how much of that deceleration in inflation that we've witnessed, seen so far, experienced, has been a consequence of the tightening of the last 12 months from the Federal Reserve?
Yeah, I mean, frankly, I think very little of it has. So interestingly, inflation is always a lagging indicator, but it seems like this cycle, inflation is actually leading a little bit here. So inflation's coming down without an increase in the unemployment rate, which just suggests that the reason why inflation's coming down is because we're finally getting these pandemic-related shocks to inflation that are fading. And we think that's definitely going to be the case, even going into the September FOMC meeting. seeing. So there's going to be some nice tailwinds that the Fed is going to get on the inflation picture, from a decline in used car prices, which were, very idiosyncratically increased throughout the pandemic. But you also have shelter prices, which are going to moderate. So that's going to be a tailwind for the Fed in the back half of this year. But the key question in our view is, what does wage inflation do? Because if wage inflation remains sticky, which we think that it could as labor markets remain tight, you could actually see some reacceleration in core inflation into 2024.
Will the Fed tolerate that, Tiffany? Because in your secular outlook, you guys, the team, Tiffany, you and others, suggesting that maybe they will tolerate 2 point something, maybe not 3 or 4, but 2 point something.
Yeah, I mean, certainly they, I think they could definitely tolerate a little bit of above target inflation. Ultimately, but the question is how much? They're not going to want to push the unemployment rate even higher. I think if you do get inflation that's sort of running above 2%, they could continue to forecast it moving back to 2 as a result of monetary policy lags, but it kind of never really gets there. Now in terms of the near-term trajectory of the Fed, we think obviously they're going to be hiking in July, could hike again maybe in the back half of this year, but maybe not, because the inflation picture could look good. But that doesn't necessarily mean they're going to be cutting rates until they see more evidence that the labor market is weakening and they're less worried about these sticky wage inflation trends.
Mike, Tiffany mentioned the lags in policy. When do those long and variable lags start to bite from your perspective?
Yeah, they're biting, right? As Tiffany mentioned, I mean, they're hitting the most levered, the most susceptible consumers, corporations, obviously any company with a floating rate loan, and you see that in the real estate market, it hits pretty hard. So it's already happening as all of this debt, which had been refinanced, over the last couple of years, Jonathan, at really low rates, starts to roll over, that really starts to bite. And you're seeing, like the average life of the high yield market is really short right now, right? They pushed out their maturities, but they're going to have to pay the piper over the next couple of years. So that's when it really starts to bite. But I don't think the Fed is really going to allow inflation to stay elevated. They're going to keep that funds rate, Jonathan. This is the key point, way above inflation, meaning they're going to maintain a really high positive real funds rate potentially for a long time, right? And that will weigh on growth ultimately.
Chris Mamani is joining us a little bit later this hour, making the same point. So we'll discuss what that means for the equity market. Mike, can we just sit on the credit market a little bit longer and the prospect of defaults climbing from here? Torsten Slock of Apollo, a man I'm sure you know well, wrote this morning, that markets aren't taking the ongoing rise in default rates for high yields and loans seriously. He said many investors argue this is just the normalization, or these companies are companies nobody has heard about. He said the reality is that more and more companies are defaulting because the cost of capital is higher. Higher cost of capital is precisely how monetary policy works, obviously, by making it more difficult to get financing. And he ended with this line. I think this is important, Mike, and I'd love your comment on it, your reaction. All investors should have a view on how high they think default rates will go during this cycle. Do you have a view on that right now, Mike? And does that back up why you're still underweight both investment grade and high yield at the moment?
Yeah, I mean, we definitely have a view, and the view is that the default rate is going to increase, right? That's really a foregone conclusion. The question is how high does it get? And our view is that, it goes from, it's been kind of 1% to 2% for the last year or two, really low, and it's going to go to 3 or 4%, which is actually close to, maybe even slightly below the historical average. And in a world where the default rate is averaging, let's say 4% a year, Jonathan, the average spread on the high yield market that you need to compensate for that is about 400 basis points over treasuries. Today, that spread is right around there, right? So if you have the view that the rise in default rates is going to be rather benign, the high yield market is a little expensive right now, maybe fair value or a little expensive. Of course, the risk is that the default rate goes to 5 or 6, even for a short period. But we're really in the pretty benign default scenario camp.
Mike Collins, Tiffany Wilding, two of the very best, just awesome, going into the Federal Reserve decision tomorrow. That 2-day meeting commences today. Your equity market just slightly negative on the S&P 500 with some movers going into the open. Here's Abby.
Hey, John, and we actually have some breaking news on this morning, just a couple minutes ago, with Amazon iRobot amending their acquisition price to $51.75 per share from $61 per share. The price change reflects the iRobot entering into a $200 million financing facility to fund its ongoing operations. So this new price basically takes into account that debt. On this, iRobot is on pace, I believe, for its worst day this year. Turning to some other movers on the morning, GE, they basically put up a blowout beat. They lifted their outlook on surging aerospace demand, plus the rebound in renewables. RTX, they recently changed their name from Raytheon Technologies. That stock is sliding pretty significantly at this point, down about 9%. They disclosed an engine defect in a quarter that otherwise beat on the surface, but that is weighing on free cash flow. And then finally, Spotify down about 6%. Their revenue miss offset the subscriber forecast. That stock, though, John, up more than 100% into this year. Price for perfection, they didn't get it. The stock is down.
Abby, thank you. Much more on the earnings front around the open and bow. Coming up next, China's latest stimulus efforts fueling a big rally.
China is one of our preferred markets within emerging markets. We think that policy stimulus is important. Markets had relatively low expectations coming into the Politburo meeting.
That conversation up next.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
This is Bloomberg.
China is one of our preferred markets within emerging markets. We think that policy stimulus is important. Markets had relatively low expectations coming into the Politburo meeting. I would say the overall measures we got yesterday was slightly more dovish than people expected. The details of what the actual measures will come through in the next kind of weeks and months are important to look out for.
China's latest stimulus efforts finally starting to win over some investors. The Hang Seng Enterprise Index recording its best day of gains since November, back when China started easing COVID restrictions. The yuan, the currency, touching its strongest level in more than a week. Strategists over at Morgan Stanley saying this: overall, we believe the statement exceeded investor expectations and effectively gives the State Council a green light to provide further easing measures in the next few weeks. Enda Curran joins us now in Washington, D.C. for more. Enda, let's start there. What kind of easing measures can we expect in the next few weeks?
Well, I think it's the tone of the messaging from the Politburo that's excited global investors, John, more than the actual substantive. We haven't had too much by way of detail, but the broad expectation is we will see more measures to boost the housing markets and make it easier for developers to finish projects and for people to buy new homes. There's expected to be some measures to boost local government financing, maybe let them sell bonds so they can build more infrastructure projects. And then on the consumer side of things, measures there to boost household spending on appliances and furniture and the like. Now, the critical sentence that came out of everything for the Politburo was the line that they dropped, which is houses are for living in, not for speculation. That line was taken out for the first time since 2019, hinting perhaps at something of a reprieve for the real estate sector. So as I say, a shift in the tone more than the substantive, but maybe those details will come over the coming weeks.
And you were in Hong Kong, you're in Washington now. A feature of this conversation this morning is just the differences emerging between, say, China, Europe, and the United States for that matter. Could you frame that for us, Sender? Just the difference right now between what China's going through and what the US is experiencing.
Yeah, so the big story was meant to be China would help reflate much of the global economy this year. It has to some extent, but it's fallen short, John. We're not seeing the spillover from China to trading partners, either via services channels like tourism or education, or via demand for commodities. And the end result has been, when you look at the US, consumer story is pretty robust, pretty healthy. The talk of a recession has been pushed back again. But China, of course, is heading the opposite direction. Consumer has disappointed, still spending, but disappointed. And of course, they're not talking about inflation, they're talking about deflation there. So definitely a divergence in the performance. But all that said, China should still be on track to hit the 5% growth target backed by the measures announced by the Politburo, which of course would still be a pretty healthy growth clip for an economy of that size.
Enda, thank you, sir, on the latest. Enda Curran down in Washington, D.C. Those announcements from that Politburo, of course, made yesterday. The market reaction in today's session in China responding to it. A lift in Chinese equity markets. You don't see that stateside. Equity futures negative this morning by 0.05%. About 10 minutes out from the opening bell. Federal Reserve decision, two-day meeting begins today. Decision, of course, tomorrow. With a final word on that, Tiffany Wilding, Michael Collins, back with us. Tiffany, the guide for tomorrow. The question I've asked repeatedly in the last week, is this Fed one and done, or is there more to come? What do you think?
Well, I mean, clearly, my central ball is probably just my crystal ball is just as cloudy as yours. But ultimately, I think it's going to depend on inflation as well as the growth trajectory in the back half of this year. And we think that's going to look very different than the first half. So the first half, we saw growth re-accelerating on a real basis, as consumers had more real spending power, energy prices falling down. But we also saw inflation that was a little bit more sticky than many people were thinking. In the back half of this year, we think inflation really starts to decelerate, and as I mentioned before, there's some real headwinds to economic growth as a result of lower, tighter credit conditions, and of course the student loan issue. So we think that's probably going to be enough for the Fed to hold rates steady after this meeting. But of course, things can change, and obviously, we'll get a lot more data between now and then to try to figure this out.
They've changed 5 different times this year already, as you all know. Michael Collins, same question to you.
Yeah, they're going to hike tomorrow, obviously. That'll probably be their last one for the cycle, but I may have said that same thing a year ago, so it is difficult. But our guess is, again, given all those leading indicators rolling over, that they're done after tomorrow. And in a year from now, the funds rate will be lower, probably 50 to 100 basis points lower, but probably not go as low as what the markets have been pricing in. So that's really the view here.
So I hear from other people as well. Tiffany, let's finish there. Michael Collins talked about the prospect of higher real rates for longer. Do you see evidence that this economy can tolerate that?
Yeah, well, I mean, it's a little bit tricky because it all gets back to how monetary policy lags are working. And are they longer or maybe shorter this time? Various Federal Reserve officials have argued maybe they're shorter, but I think that the increase or the balance of evidence that we're getting is that maybe they are a little bit longer. Maybe the pandemic-related stimulus and some of the backlogs from bottlenecks is just creating much more runway. So that suggests that maybe they do need to keep rates higher for longer. But nevertheless, at some point, these kinds of stimuluses are going to run out. And the question is, what happens then? Does that increase the potential for some nonlinear effects, i.e. the economy weakens in a kind of surprisingly strong way at some point in the future? Of course, economists are historically very terrible at pinpointing when recessions occur, so take this for what it's worth, but ultimately these are the kinds of things we're going to be looking at as we move into 2024.
We know how it's worked so far this year. Just keep pushing out the call. Just another 3 months. Just keep pushing it out. Tiffany, it's been wonderful to catch up. Thanks for being with us today and carving out some time in your schedule. Likewise to Michael Collins. A busy couple of days for those guys and, of course, for everyone going into this week with tech earnings after the close, Federal Reserve decision tomorrow, ECB Thursday, BOJ on Friday. Equities right now on the S&P 500 just turning negative in the last 20 minutes or so. In the bond market, just to round things out for you, looking at treasuries, just slicing up the yield curve, 2s out to 30s. Your 2-year yields up a few basis points, up by 4 on a 2-year this morning to about 4.90. Your 10-year at about 3.91. 30-year about 3.95. Coming up, the morning calls, and later, Lafayette's Krishna Mamani sounding the alarm on the bond market this time, saying the long end looks vulnerable. We'll catch up with him, plus Evercore's Mark Mahaney setting the stage for big tech earnings with Microsoft and Alphabet results coming up a little bit later after the close.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Five minutes away from the opening bell, equities just a touch negative on the S&P 500, down by 0.06%, call it 0.05. Not much at all. On the Nasdaq 100, a little bit of a lift, up by 0.2%, going into tech earnings a little bit later. If you get to the FX market, the euro negative for a 6th consecutive session. Longest streak so far this year, going back to September of last year. Euro weakness against the dollar. The data out of Europe, yesterday the PMIs. Germany today, just not great. Euro dollar right now, 110.27. That's the price action. Let's get you some morning calls. First up, Piper Sandler upgrading Walmart to overweight with a street high 210 price target, expecting the retailer to benefit from the inflationary environment. Citi downgrading Goldman to neutral, seeing a balanced risk reward and challenging backdrop for investment banking. We're down there by 0.9%. And finally, New Street Research upgrading Meta Platforms to buy, highlighting positive feedback and growing excitement surrounding, guess what, recent AI efforts. That stock is up by another 1%. Coming up, Lafayette's Krishna Mamani joins us for the opening bow, plus looking ahead to big tech earnings with Evercore's Mark Mahaney, Microsoft and Alphabet. Coming up after the closing bell, your opening bell is just around the corner.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
News breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI semi sort of trade here.
The $69 billion deal is the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Twenty-four seconds away from the opening bow this morning. Good morning. Coming up a little bit later, after the close this afternoon, Microsoft and Alphabet. Microsoft so far this year at 44%. Google at 38%. These are big year-to-date gains, looking for some validation. Equity futures a bit softer. There's your opening bow. Switch on the board and get to the bond market. Treasury yields looking a little something like this. Your 10-year yield higher by 4 basis points, 391.62. The dollar showing some strength. Euro dollar 110.27. That's some euro weakness right there. Negative 0.33% on that currency pair. The longest losing streak for the euro against the dollar going back to late September of last year, when King Dollar was absolutely crushing the euro and sterling as well. In the FX market, that's the story of the moment. In commodities, crude just a little softer, lighter, lower. We're negative there, 1/10 of 1%, $78 and about 64 cents on WTI. 30 seconds into the session, your equity market looks like this on the S&P, just slightly negative. On the NASDAQ, just slightly positive. One stock to watch at the open, 3M. The company topping earnings estimates and raising its outlook after implementing sweeping cost-cutting measures just last year. The CEO saying this: the actions we took to strengthen and restructure the company led to reduced costs and better than expected margins and free cash flow. Abby has more. Morning, Abby.
Morning, John. And yeah, the stock is popping and everything you just mentioned. And it was basically a blowout quarter. They beat revenue by about 6%. They beat adjusted earnings by 25%. Not small numbers either. $2.17 in adjusted earnings on $8.3 billion. So this company sells, as you know, everything from tape to auto parts, electrical components, and so much more. So the point there is it's a very broad read on the economy. So the fact that they beat, that is a positive. But there was a reason for the adjusted earnings beat being so outsized, having everything to do with those cost-cutting measures that you were talking about. The margins, sales declined, though this is a positive. Organic sales declined 2.2%, much better than the expectation of a decline of 4.5%. They did take a $10.3 billion charge to settle their part in a Forever Chemicals case. But overall, the company says that the goal of all of this is to position the company for the future. Speaking of the company, they raised the outlook. They're now looking for a range of $8.60 to $9.10 in adjusted earnings, up from the previous range. All is well here. The one thing, though, is, John, because of some of the litigation hanging over the company, the stock is down 10%. But with this sort of an outlook, who knows? Maybe it is on the move toward a more positive year.
It's up this morning, 3M, advancing by 3%. Abby, thank you for that. Spotify delivering a miss on revenue, to be specific, which overshadowed its monthly active user forecast that was better than expected thanks to younger listeners. Simone Foxman has more. Morning, Simone.
Morning, John. Yeah, those user numbers coming in really hot, stunning Bloomberg intelligence for the like. But total active users up 551 million, especially because of Gen Z. However, those weaker financials really weighing on the stock this morning. Shares now down around 9% after falling substantially in the pre-market. Was that miss on revenue slightly below Wall Street's forecasts as well as the company's own estimates? It was also the worries about the margins. Gross margin coming in at 24.1%. They've been hanging around that 24-25% level, even though the company in the long term wants to get to 30% gross margins. They're looking for 26% next quarter, but analysts not really sure how they're going to get there. We've seen a sell-off since July 19th. The sell-off that JP Morgan says is overdone. But when you look at gains this year, the stock's still up about 90%. So we'll see how traders try and parse all this data today.
Simone, thank you. On course, if we close around these levels right now for the biggest one-day drop going back to December of last year. So worst performance of the year so far intraday. Spotify at the moment, fourth day of declines for that stock. I want to turn to the auto sector. GM out with earnings this morning. The car maker raising its outlook amid strengthening demand for its diesel-fueled SUVs. The CFO, Paul Jacobson, catching up with us a little bit earlier this morning.
I'm not sure that we're going to be able to raise prices across the board. We see a lot of stability in the market. We're just kind of taking it one day, 1 month at a time and watching the results come in. We've got to be focused on quality, and we've got to be focused on getting production in the vehicles that customers want.
Joining us now is David Welch, Bloomberg's very own. David, I have to say he sounded upbeat. Were there good reasons to be upbeat?
General Motors hit it out of the park in terms of beating estimates. They hit it out of the park in terms of raising guidance for the year, so they've got good demand. Prices actually increased first quarter to second quarter, and they're saying that's going to be stable. And we're talking about prices that are already at historically high levels. So the scene is all set for GM to make a lot of money. I still think there's an overhang on the stock with investors that there could be a strike this fall, which last time it happened, it cost GM more than $2 billion. And I do think still there's kind of a wait and see on GM's electric vehicle program, which is kind of stuck in second gear at the moment. So, look, great performance from the company. They're cutting costs. They're growing market share on that old internal combustion side of the business, but there are a few things that investors, I think, are still taking a wait-and-see attitude about. At least they were with pre-market trading, for sure.
What would you point to right now based on the early price action? When the numbers came out, and they came out a little bit awkwardly, but we won't go over that now. Looking at the stock down by 4 or 5%, that's not what I expected when I first saw the numbers this morning.
Yeah, I do think because GM had such a great second quarter in terms of unit sales in the U.S., which drives most of their profitability, and that news was out early in July. So some of this was already baked in. Investors knew it was going to be a very good quarter in terms of selling trucks and SUVs where they make a lot of money. I do wonder if the fact that CEO Mary Barra specifically called out labor negotiations in her letter, if that sort of reinforced fears among investors that there could be a strike this year, that maybe thou doth protest too much about the market's fear of a labor contract year. And UAW President Sean Fain has had some pretty fiery rhetoric about negotiating with the big three and how much money they're making. I think there's some of that. And the EV story is still not fully baked enough at General Motors to garner a lot of enthusiasm, but it could also be just an issue of, okay, this is as good as it gets in terms of GM's profitability, and that's always kind of been an issue with the Detroit car makers. They have a great quarter, and Wall Street just doesn't believe there's much on the other end of the rainbow, so they don't really buy in.
Stock's down 4% right now. David, thanks for the update. David Welch there on the latest from General Motors. Let's turn to the home builders. What a bright spot so far this year in the equity market. Pulte Group topping profit and revenue forecast thanks to continuing demand for new homes. The CEO saying this: While there remains an extremely limited supply of existing homes, we have a much improved supply chain that has us well positioned to meet demand going forward. Katie has more. Hey, Katie.
Hey, John. Currently, you look at the stock market, shares are about 3% higher at this morning after, like you mentioned, Pulte Group beat on second quarter estimates. We're talking revenue, adjusted EPS, and homes closed all came in higher than estimates. However, unit backlog, it did increase to a value of $8.2 billion at the end of the second quarter. That's up from about a value of $7.9 billion at the end of the first quarter. Now, also, as you mentioned, CEO Ryan Marshall, he did say that Pulte Group is well positioned here to meet that demand going forward as existing home supply remains extremely limited. That's a similar message to what we heard from D.R. Horton just last week, that there's just not a lot of housing supply in this economy. And of course, that's been a tailwind for these home builders all year, really, from that demand standpoint. And now they have to continue to deliver that supply. Look at Pulte Group, again, currently higher than 3%. For context, it's already up 76% so far this year.
Year-to-date gains are just phenomenal. It's just unreal to see what the home builders have done. Katie, thank you. Thank you for that. Krishna Mamani of Lafayette, expecting the solid economic landscape to keep a floor under stocks, and writing this: housing remains strong, manufacturing data is actually recovering. That and valuations will keep equities in a range, but makes the long end of the bond market very vulnerable, which in turn makes every part of the market very vulnerable. Krishna, I'm pleased to say, joins us now. So, Krishna, let's get straight into it. The bond market, the 10-year right now is at 390. When you say vulnerable, what are you thinking here? 50 basis points, 100 basis points? Can you put a number on it?
Yes, I don't think it's 100 basis points. I think 4.5 is probably the top end of the range for 10-year. I think a couple of stories that you just talked about kind of highlight why the bonds, the long end of the bond market may be vulnerable, which is look at housing. Housing is doing spectacularly well, at least new construction, if not existing home sales. And I think in that sort of an environment, the risk of a re-acceleration in the economy is substantial. And I think it's that risk that makes the long end of the market far more vulnerable. The talk of a recession has been postponed, and it probably gets postponed even early 2024. So I think that's not the driver that can take rates lower. On the other hand, any whiff of a re-acceleration, and we get through 4% very quickly.
So, Krishna, in the last 30 minutes, we caught up with PIMCO. Tiffany Wilding told us that student loan repayments resume later this year. We know that. She expects them to bite growth. She's looking for a deceleration in economic growth because of some of that and other things too. What would you push back against to say that's not the case?
Well, so I think that there are two basic kind of drivers there. One is employment. Employment is not showing any sign of slowing whatsoever. And as long as that is the case, real incomes are increasing, that supports consumption. So that's one thing. And the second thing is the cyclical part of the economy. Housing, for example, remains extraordinarily strong. And manufacturing, which we were counting on to kind of drive the slowdown in a potential recession, is kind of stabilizing. With all the fiscal stimulus that is still in the system and likely to remain in the system for an extended period of time, I don't think it's very unrealistic to expect a modest re-acceleration. And a modest re-acceleration is all we need for this, for the long end of the market to become very vulnerable.
So, Krishna, is that good or bad for stocks?
Well, so I think stocks are okay because nominal growth is pretty high, and as long as that is the case, and we are still in a stimulative environment in terms of fiscal policy, I think stocks probably hold their own. They probably don't go to 4,800, 4,900 anytime soon, but I think they can hold this middle of 4,000s range for an extended period of time. I think if rates go meaningfully higher, then everything kind of becomes far more questionable. But at the moment, I don't think that is the case.
Do you anticipate that given what you're looking for, the chairman of the Federal Reserve has to manage that risk, and ultimately that could shape the message we get received from the chairman tomorrow in the news conference?
Well, I think first thing is they're going to tighten. Everyone knows that. But I think there is absolutely no reason for the chair to tone down anything. That doesn't serve any purpose whatsoever, and he probably antagonizes a lot of people on the committee. So he's going to stay on message on that front. Whether they tighten in November or not, which is probably the next likely point, there's a lot of time to figure that out. Irrespective of that, as inflation comes down, real rates are increasing. So that is doing a lot of the work of the Fed, even without them raising rates. So I think they're at a really good spot. Things are working out according to their plan. They just have to hold on to that particular position.
Krishna, how difficult do you think it is to keep everyone happy on that committee right now?
Well, so I think that there are folks who are still very worried about inflation and the fact that core is not coming down soon enough, and the employment remains relatively robust. I think that certainly creates a bit of angst for certain of the members. But I think as inflation continues to come down, they can't really raise too much ruckus, because if they raise too much ruckus and as a result policies tighten significantly more, that increases the risk of the soft landing that everyone is hoping for, including the hawks.
Krishna Mamani of Lafayette College on the latest in this market and on the Federal Reserve. Krishna, thank you, sir, as always. Looking ahead to the Fed, that's tomorrow. That two-day meeting begins today. About 13 minutes into this session, we advance on the S&P. More recently, some underperformance in the NASDAQ over the last several days. Some outperformance today. The NASDAQ 100 higher by 0.4%. Coming up, a big afternoon for the NASDAQ. Looking ahead to big tech earnings with Microsoft and Alphabet after the close.
I think everybody that wants to start these initial rollouts of generative AI are paying a top dollar. This is a super cycle. I just think that we may be a little bit ahead of reality.
That conversation up next with Evercore's Mark Mahaney.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to be produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
season is here.
Decent start to earnings season.
We are heading into the meat of earnings season.
Bloomberg breaks the numbers first.
We have Bank America, we have Charles Schwab.
Tesla, Netflix, you name it.
They're heading in the right direction.
A record quarter of revenue.
With exclusive expert analysis.
What do they have to deliver to justify the rally we have seen?
Earnings are still going to be under pressure.
Is there a divergence that's really important to draw here?
The massive divide between Diamond and Fraser.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The rally is and has been certainly broadening out. And to be clear, through the spring, it was undoubtedly the so-called Magnificent Seven. I mean, there's a bit of revisionist history going on that somehow the broad rally has always been the case, that it's not just 7 stocks. For a long period of time, it was just 7 stocks. But you have a tremendous catch-up now on the part of small and mid-caps, as we know, and the rest of the index is playing a bit of catch-up as well.
40% of the S&P 500 reporting earnings this week, a critical stretch for big tech, looking to justify their valuations following the Nasdaq's best first half on record. The results coming after the closing bell with Microsoft and Alphabet, then it's Meta's turn on Wednesday. Evercore's Mark Mahaney has outperformed ratings on both Meta and Alphabet, seeing Alphabet revenue in line with expectations and saying this: "We view the street's revenue estimate as reasonable, given our ad channel checks suggesting largely stable search ad spend growth, robust global travel demand, a potentially thawing ad winter, and FX turning to a tailwind." Mark Mahaney joins us now, Senior Managing Director at Evercore ISI. Mark, wonderful to do this with you, as always. Ad spend is still the business at Google, so let's go there straight away. What are you looking for a little bit later?
Well, I think that quote you cited earlier is, I don't think there's any change in our view there. We're seeing these small bits and pieces of evidence that the ad demand is starting to improve, but they're really small. They're tentative pieces of evidence, and I'm not sure that Google is going to outplay that improvement. The checks we had showed that search growth was kind of stable in Q2, stable at a low level versus Q1. So there's still some work that needs to be done there. And then the company still on the YouTube side of the business has been working through a couple of, I think, execution issues recently, and is still a little bit lagging Meta in terms of responding to the Apple privacy changes and then the impact that that's had on performance marketing campaigns. So there's still more wood to chop with Google. What I think investors would love to see, leaving aside the ad revenue, is real signs of greater cost discipline. I'm not sure you're going to hear that from Google, though. So, Google for us is a small buy. Meta is one of our top 3 picks. Google, we prefer that over Google, even with the major rally in Meta shares year to date.
Before we get to Meta, Mark, just one more on Google, Alphabet, and AI, if we can. You and I have heard so much from so many people about this AI investment cycle boom. Is it too early to expect an incremental boost to cloud demand this quarter, next quarter, and beyond?
I think it's too early, but I think the basic premise of your question is flat out correct, which is, I think we're going to see broader and broader deployments of generative AI applications, and it's going to be, this competitive intensity is going to be rising. There's going to be fear of missing out when it comes to not the stocks, but in terms of generative AI deployments across verticals. CIOs are going to be responding to the CEOs and being asked, what are you doing to make sure that we don't lose out? And so what I think that means is you're going to see overall rising tide for all kind of the major cloud vendors. That's Azure, AWS, and Google Cloud. Now, far and away, the 2 biggest providers here are AWS and Azure, but Google Cloud should benefit from this too. That's going to lead to greater need for cloud compute and greater need for cloud storage. It's going to be a secular driver for cloud growth that has slowed over the last year and a half. So you're going to see this re-acceleration in cloud growth, but I think that's going to be clearer in 24 than in 23.
3 stocks on the screen right now: Alphabet and Microsoft. Alphabet and Microsoft after the close. You mentioned Meta. That comes after the close tomorrow. Year to date, Mark, you know these numbers well, up 146%. To hear you say you still like this name after gains like that gets everyone's interest. In your research, you talk about how maybe the current multiple, provides some downside protection to an earnings miss tomorrow. Mark, for the people that haven't had the luxury of reading your research, could you explain that to people?
Yeah, well, look, an earnings miss is an earnings miss. Meta would correct probably materially on an earnings miss. Same thing with Google. I do think the bar is lower for Google. I think expectations are a lot lower, but I also want to put this in context. After this dramatic rise in Meta shares, it's trading at 17 times GAAP earnings. It's essentially trading at a market discount, S&P 500 multiple, or a slight discount to that. I don't think it should trade at a discount. I think Meta deserves to carry a 20 PE multiple, 20 times GAAP earnings on next year's number, because I think that's pretty close to what the earnings growth algorithm is, that the earnings growth outlook is for the company for the next couple of years. So that massive rise in the stock year to date, the context you have to have as an investor is it massively imploded last year. But fundamentals are improving. You're going to see accelerating revenue growth, margin expansion. They're buying back a lot of stock. And that I think it gives you a lot of support for the stock. I know the bar is going to be higher as we go through earnings season. We've already seen that with names like Spotify and Netflix. So the bar is higher. It's harder for the stocks to really trade up on earnings. But core valuation, I think, for a name like Meta is still highly attractive despite that run in the stock year to date.
Mark, I've got about 30 seconds. I've got to ask you about Threads for obvious reasons. 2 weeks ago, I was told it was booming. 2 weeks later, people are telling me it's failing. Which one is it?
Oh, I think it's growing. I don't know if it's booming, but it's growing. And by the way, 100 million users in a 5-day period, that's truly exceptional. It shows you the power of Instagram and the ability to turn on new features. There's a lot of things they need to do to improve the product, but I think there's a real opportunity here for this to be a lot bigger, a year or 2 years from now than it is today. I think it's another reason to own Meta.
Mark, let's do this again soon. Busy couple of days for you, I know. Thank you, sir. Thank you for giving us some time. Mark Mahaney there of Evercore on the latest with those two names. Coming up over the next 48 hours. Abby, lots to look forward to.
Certainly there is, and right now we have lots of sectors to take a look at. Not surprisingly, with the S&P 500 up just slightly. We only have a few sectors higher. Materials being helped out by 3M, tech being helped out by a lot of the stocks you were just talking about, plus NVIDIA. As for the industrials, they are the worst sector on the day. I know we generally don't talk about the Dow. Yesterday, though, done 11 up days, the longest since 2017. Let's see if the Dow can turn it around today.
What's the Dow? Abby, thank you. Coming up, your trading diary up next.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it is causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
The outperformance on the Nasdaq returns, up 0.5% on the Nasdaq 100. On the S&P, barely positive, up 0.1%, going into earnings later. That's the price action. Here's the trading diary. Microsoft, Alphabet after the close. Then it's Meta's turn on Wednesday, plus a Fed decision and Chairman Powell news conference tomorrow. ECB rate decision on Thursday. Some US GDP, and we round out the week with the BOJ and earnings from Exxon and others too. From New York City, that does it for me. I'll see you tomorrow morning to build up the coverage towards the Fed decision. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. It is a busy earnings day, busy earnings week. A lot of tech earnings out after the close. We'll check in with Bloomberg Intelligence senior tech analyst Anurag Rana to preview a little Microsoft, preview a little Google that's coming up. Ira Jersey, chief U.S. interest rate strategist for Bloomberg Intelligence, also going to join us here as we get ready for Fed Day tomorrow. What will this Fed do after they presumably bump up rates again tomorrow? What happens after that? We'll check in with Ira to see where the market is kind of looking for this Fed to go. But first, let's kick things off with John Tucker and get a Bloomberg Business Flash.
All right, we're always data-dependent, Paul, so let's give you some data. This is from the Conference Board. Consumer confidence higher than expected for the month of July, coming at a reading of 117 from the previous month reading of 109.7. The expectation was 112, so we're a little more confident. Major averages, they're mixed. We have for the 11 major industry groups in the S&P 500 higher. Materials and information technology in the lead right now. And bets that AI will revolutionize corporate America and deliver riches to the big companies behind it. We'll get a test today as we get Microsoft and Alphabet earnings. Dan Greenhouse of Solus Alternative Asset Management is seeing positive signals from the earnings report so far.
Let's look at who's already reported. The airlines have told us demand is quite strong. The home builders that have reported thus far have said demand is quite strong. The banks were terrific.
And then GM and GE reporting earnings this morning, both companies raising their earnings guidance. Right now, the S&P 500 up 7, the NASDAQ 107 points higher. That's up 0.7%. The Dow Jones Industrial Average 28 points lower. And you know what?
What?
A new Steely Dan tune has resurfaced. Never saw the light of day. This was actually, believe it or not, this was a commercial for Schlitz beer.
Once around life, once around living, once around beer and keep around Schlitz.
That is not a bad
That's
jingle.
not a bad tune.
Nobody's ever heard it before. The band was still pretty young in their career, so they were trying to do whatever they could to make money. The use of the Spanish word for grab in the jingle, however, raised objections because it's also slang for something else. So, again, never saw the light of
Only
day.
John Tucker finds these
Very
stories.
interesting.
I gotta say, the little dance you did along with it was pretty priceless.
Oh, did that go out on?
Oh, it was on there. It was great.
I didn't realize it was.
We'll have to
on
go back,
camera.
cut that, tweet it
Whatever.
out for you.
Anyway, we check the markets all day long. Markets and other stuff right here on Bloomberg Radio.
All right, John Tucker, thank you so much. We appreciate it. I'm a big fan of the band, big fan of Schlitz beer, so all good. Hey, John, you're just reporting on that confidence board stuff. I mean, the data looks good, Jess. I mean,
Rises to a 2-year high with that data. It
I
comes
know.
out monthly, and we are going to speak with Dana Peterson, the chief economist of the
Okay,
conference
good.
board, in the 11 o'clock hour. So stay tuned for that so she can talk to us more about the data, outlook for the economy, obviously ahead of the Fed.
Yeah, the conference board expectations came in at 88.3. That's up sharply from 80 last month. So a big expectations for their survey work is pretty positive. All right, let's take a look at these markets, kind of red and green on the screen as John was reporting. Let's check in with Bailey Lipschultz. He covers all the markets for Bloomberg. He joins us here in our Bloomberg Interactive Broker Studio. Bailey, what are you looking at today?
Yeah, a lot going on the earnings front. RTX, Raytheon, they're down more than 16% at the moment, the worst performer in the S&P 500. If that move were to hold, it would be the worst day since 2001. This comes after their Pratt & Whitney subsidiary said they need to remove and inspect some 1,200 of its engines powering the world's top-selling jetliner over the next year. So a huge sell-off right now going on in Raytheon, ticker RTX. One stock moving to the upside is Sherwin-Williams, beating expectations, boosting their forecast, and a bullish signal for housing. And just one more that's at the top of the radar right now, iRobot down 11% in a pack to be bought by Amazon. Amazon cutting its price per share to $51.75 from $61, and iRobot entering a $200 million financing facility to fund its ongoing operations. So a lot going on, and a handful of stocks moving to the up and downside.
I'm sorry, I'm chuckling over here about a screen grab of John Tucker dancing to this song. I'll send it to you soon,
no.
John. But
no.
moving back over to Bailey real quick. So Bailey, star reporter on our U.S. equities team, but he also does our ECM Watch column where he's obviously breaking out things all down on firms that are planning to go public. You had a recent column this week that crossed the terminal talking about how bullish ratings give little boost to new public firms. What are you finding there?
Yeah, no, the sell side overwhelmingly pounding the table for investors to buy the likes of Savers Value Village, Fidelis Insurance, Kodiak Gas, and Gen Restaurant. So all told, across the four companies, 24 analysts initiated coverage, 21 buys, and only 3 holds, no sells. But it did little to move those shares higher. It still seems like we're in an environment where the newly public companies are going to move on a case-by-case basis, and that's why you're seeing a lot of outperformance for the likes of Savers Value Village, Gen Restaurant, the owner of Korean barbecue chain Gen Korean BBQ, and Oddity. commodity, but it does seem like investors are not willing to buy pretty much anything that's going public and really want to pick their spots, and that's why we've seen such a dispersion of performance for recently public companies.
What else on the earnings beat are you seeing here today?
Yeah, you're looking at kind of all over the place. So we're looking at
some of the airlines. We had Alaska Airlines, right?
Alaska Airlines is down, one of the worst performers in the S&P 500. CFO warning of pressure from falling ticket prices, something that consumers should be applauding.
Yeah, but I don't see the falling ticket prices, but I guess it is a thing. Okay.
Well, it's hard when your year-over-year comp is to last year, where you were boosting these prices straight up and to the right. 3M is another outperformer after their results came in better than expected, as is General Electric. So it does seem, and obviously you can see that right now with the some of the performance that's been happening, it does seem like some of these more industrial companies are beating expectations. Again, though, the big drag for the Dow, which is underperforming, is all on Raytheon. So in that drop, or I'm sorry, all on Boeing, which is accounting for 27 points to the downside. So even if you have good results from 3M, being balanced out by some analysts or strategists really moving away from the airline space, again, just given the Alaska Air numbers weighing on Southwest and United Airlines, and the Raytheon update, which putting a bit of a dent in a group that, for the most part, had been flying high this year.
When we're seeing, obviously, we have these big tech and growth companies reporting after the bell when it comes to Alphabet, Microsoft. We just had Netflix last week, as well as Tesla. What are you seeing when it comes to the retail positioning heading into some of these big tech earnings?
Yeah, they're still being very much exposed to it, Jess. So they're still, again, snapping up the likes of Apple, Microsoft, and Tesla. The big thing that I'm interested in seeing is Microsoft. Microsoft historically has moved quite a bit after earnings. You look at the options implied move, 5.2%.
Wow.
This is a big company. Yep. So that's not a small move for a $2.6 trillion company. So,
and we were just talking to Anurag Rana in the last hour with Tom Keene, and I was just looking at the BQ function and just kind of seeing how the market cap, the company added like $800 billion of market cap just this year. So if you were a shareholder in Microsoft,
right?
I mean,
that stock's up over 40% this year alone.
It's amazing. A company that size can have that kind of move in market cap.
Well, that's one of the interesting things tying it back to IPOs. Is I was talking to a couple bankers yesterday, and they were calling out that part of the reason they're seeing so much demand for new issuance is because if you were not overweight Microsoft, Meta, in the big tech, NVIDIA, the tech stocks that have been driving the market, you're trying to catch back up. You're underperforming your benchmark, so you're deploying cash. And as you mentioned, you look at a stock like Microsoft, it's up 45% year to date. That is a stellar move.
Right, and especially looking at its market cap, around $2.5 billion, so getting close to Apple as far as rivaling that $3 trillion valuation, so it's pretty astounding there. And then Alphabet, I mean, that stock's up about 38% this year, so still slightly under the NASDAQ 100, but killer moves here with these tech stocks.
Yeah, and we'll see after the close today. You have Microsoft and Google, so we'll see what kind of tone they set. Again, it's all about